8:30 a.m., we do get personal income, personal spending, and PCE core deflator. That is the key metric the Fed is looking at. And typically, to understand the forward trajectory, it is expected to decline further from 3.4%. Is it enough? Does this confirm the disinflationary kind of Goldilocks that people are celebrating? Or does it start to signify maybe any kind of shift in the narrative? At 10 a.m., we get new home sales as well as University of Michigan sentiment survey. Very curious to see whether or not you get an uptick in the sentiment index, especially given what we saw in recent other surveys that came out. And it is a holiday day. I mean, it definitely feels like the last gasp before everyone goes on vacation. And I'm not just saying this because I'm going on vacation. Treasury markets are closing today at 2 p.m. And it is kind of a quiet morning, a little bit of softness. But if this is another gain on the week for the S&P, that makes 8 straight weeks of gains. That is the longest, going back more than to 2017.
It's pretty amazing. You think of all the capitulation we've seen as a result, especially from the sell side. I will say, to the early Treasury market close, why can't the equity market get on board? It feels like this always happens, that the bond market closes, but the equity market is on a little bit of a different schedule.
I think the bond market probably has it right.
They usually do.
Right? So, I think everyone should just follow suit and just take the time off. Maybe doing the same. Senior global macro strategist at State Street joining us now. Marvin, do you have an answer to that? Why the bond market tends to kind of beat to its own drum versus the stock market?
I couldn't agree more with your assessment. So for sure, we should start our celebrations a little bit early if we can.
Meanwhile, we were talking about how treasuries are basically unchanged on the year with a very tumultuous path. Do you think that stocks are getting the message that treasuries are sending right now?
You know what? Certainly there's reason to be optimistic within the risk assets. It's really just a matter of how aggressively things have moved, and really the counterweight between looser financial conditions and ultimately the package that the Fed is trying to deliver with regard to inflation, with regard to growth. And it does, to a certain degree, push back against it because financial conditions have loosened as aggressively as that 10-year yield has come down.
And Marvin, I want to talk a little bit more about what we're seeing in the Treasury market, particularly at the long end of the curve. Of course, Lisa brought up that you maybe are starting to see some growth fears seep in. And you think about this incredible move that we've seen in 10-year yields, in particular, since about mid-October or so. Is that growth fears? Is that maybe a FOMO grab when it comes to duration? How do you explain what's happening at the back end of the Treasury curve?
Yeah, I mean, for sure, if you will, what we talk about is the left tail risk. The risk that there's a significant sell-off, let's say, in bonds or stocks for that matter. And the Fed kind of took that off the table. Once they signaled that they were done with the hiking cycle, we don't have to worry about the left tail from that perspective anymore. So, we're really trying to figure out how much of this we want to buy. I think the inconsistency is like to think about rate cuts that begin in 3 months. So, within a quarter, the Fed is going to start to, at least from a market perspective, the Fed is expected to start cutting. In my mind, that only happens if really bad things happen in the economy. And I don't see that. It definitely is moving in the right direction. But in terms of, jobs cracking and inflation all of a sudden collapsing, it's not there in the data, despite the fact that the Fed is hinting that there are other things that they're looking at in the data. And I'd like to know what that is, if in fact it's true.
And Marvin, to your point on the timing of rate cuts, I really like this line in the notes that you sent over, that the Fed cannot afford to cut and then need to hike again. Why is that?
Sure. I mean, the credibility of the Fed has been called into question all year. I mean, they've really moved with the tide as aggressively as you can. The worst environment in my mind is one where they say that they're signaling all clear, mission accomplished, and they cut. And those inflation fears in the middle of the year, whether it's because base effects start to wane and or the labor market remains stronger, and therefore wages remain stronger, and they need to somehow put a more tightening message out there, then they lose control of all their forward guidance, which in a lot of ways that they are losing control of, given how aggressively this market has moved, while they continue to push back on the move.
So you think the risk, Marvin, is of inflation overheating and actually reaccelerating rather than true weakness in the economy. Is that right?
As far as everything I see, that is a concern. And I think kind of this balance sheet discussion, which is starting to make its way into the foreground, is part of that. Not only is the QT process in play, if you will, but if the QT process stops early, let's say they coordinate the start of rate cuts with the stopping of QT with a massive balance sheet, I do think that you have re-accelerating inflation concerns just because the balance sheet is so big and just because all of those reserves, if you will, that are out there remain out there.
How have you changed your view since the Fed pivot? Right? It seems like everybody is scrambling to reassess their baselines going into 2024. How much have you actually changed yours?
Yeah, I haven't that much. I've really used kind of this balance sheet discussion to help guide me in terms of the thought process with regard to what the Fed should be doing versus what the data ultimately is saying. The Fed should be getting their financial balance sheet in order before really getting to this phase of cuts. We've got too much liquidity in the system, and there are economic and inflation implications associated with an ongoing large balance sheet, which I don't think anyone would, I don't think anyone on the FOMC would have thought that they would be considering stopping the balance sheet when it's still over $7 trillion.
Let's talk about how the Fed talks about the balance sheet, because, of course, the consensus seems to be that, okay, if they're cutting rates just to get out of very restricted territory, maybe get back to neutral, that QT can continue on. If, of course, they're cutting because there's a recession, then that becomes a little bit more challenging. But assuming it's the first scenario where they're cutting basically to get back to neutral, how do they explain that to the American public? And do they need to, that they're continuing, of course, to run off the balance sheet in the background?
Yeah, they do need to explain it. It's incredibly complex if they're, on the one hand, loosening financial conditions by cutting rates while continuing to theoretically tighten. I'm not in the camp that they would go down that route. I know Chair Powell raised that prospect that normalization can continue. Normalization on the rate side of things would allow them to potentially continue the QT process. I think what we've seen over the course of the last 2 to 3 quarters is a Fed that's coming to the conclusion just based on the number of the many that say that you can do two things in opposite versus very few that think that now. I think that they're going to be linked at the hip ultimately.
So, Marvin, just heading into 2024, what's your highest conviction trade?
Yeah, I think risk assets have moved too far. If I were to look at this, I would be concerned with valuations on the equity side of things. I do think that we've probably seen the best from a yield perspective for at least the next couple of quarters, and there's probably better lower yield type discussions that evolve outside of the U.S. Certainly we're seeing growth concerns pop up in Europe, and those cuts seem more justified than what we're looking at here.
Marvin Lowe of State Street, thank you so much for your insights, talking about some of the weakness and the cuts that might be justified in Europe. They're not necessarily saying that, and certainly you're seeing euro strength, regardless of some of these expected cuts. You're also seeing Swiss strength. Did you see that the Swiss franc rose to its strongest versus the dollar going back to 2015, with people kind of gaming out, okay, well, maybe they'll actually enjoy a stronger currency to bring down inflation domestically.
What does the signal mean coming from the Swiss? Of course, we think about growth fears maybe getting priced into the treasury market. When I think about really rapid Swissy strength, it seems concerning when you think about the haven aspects.
Especially given the fact that it's pretty much across the board, although it's not necessarily versus the euro right now. This is very much a dollar weakness story, as well as people game out whether the Fed really has pivoted, it's going to cut rates. We shall see. Right now in markets, a bit of softness, although unclear. Can we eke out an 8th straight week of gains on the S&P, basically unchanged, down, what the hair. And we're looking at euro strength crossing the 110 mark. Again, this is really interesting to see the dollar really on the back foot heading into 2024. 10-year yields hovering around that 3.86% level, and crude just bouncing around that same level of $75 to $74 a barrel on the WTI. Coming up at 7 a.m., we get hear from Eddie Ardeni of Ardeni Research. This is Bloomberg.
Very important to understand that the Houthis aren't attacking just one country. They're really attacking the international community. They are attacking the economic well-being and prosperity of nations around the world. So in effect, they've really become bandits along the international highway that is the Red Sea. The Houthis need to stop these attacks. They need to stop them now.
That was Major General Pat Ryder, Department of Defense Press Secretary, addressing the Red Sea conflicts. A growing number of voices try to get some stability there. Insurance costs are rising for some of these container ships, and we are seeing a lot of shipping companies adjust their routes. Welcome back. This is Bloomberg Surveillance. Tom and John are both off today. I'm so pleased to say that Katie Greifeld here alongside me. We are seeing a bit of softness to end the week, although things can change, and it's basically unchanged. What we are looking at is yields materially lower over the past 2 months, kind of hovering around that 3.86%. And crude, really interesting to see that crude has hovered around $74 to $75 on the barrel on WTI, Katie, especially given the fact we've had all these disruptions, we've had record demand, we have had supply cuts from OPEC, and still we've seen that persistent sort of weakness over in the crude sector.
Yeah, I have to say crude is one of the more interesting, more confusing stories this year. It seems to all be predicated on supply. And of course, interesting just yesterday, getting some OPEC drama with Angola leaving OPEC. I know we're going to get into that a little bit later. Excited for that one.
I am too, especially given the fact that a lot of this has the backdrop of the United States production, which is not gangbusters, despite what the administration is deciding not to talk about. And I want to really dovetail that into industrial policy. going into 2024. I'm so pleased to say Kim Wallace, head of Washington Policy Research at 2022 The Research, joining us here in studio for the holiday party, for the holiday spirit, for New York City. Thank you so much for being with us. We really appreciate it.
Good morning. Happy to be here.
Good morning. I know that you put out an outlook for what to expect in 2024, and I want to start in industrial policy, hinging off the latest news of U.S. Steel and some of the administration pushback to a Japanese conglomerate purchasing the largest steelmaker in the country.
Well, there's a lot of analysis that will go into the ultimate reaction from the administration. Obviously, the Committee on Foreign Investment in the U.S. will investigate the proposed merger. But when you break it down, the promises made by Nippon probably upset a few people on the political side, but don't, in my view at least, imply disruption to the production of steel in the U.S. The deal proposes to combine globally number 4 and number 27. So the first question for the competition policy reviewers is it a global market you're defining when you review the deal or the national market? My sense is it will be a global market. And if that's the case, we look at Japan as a strategic partner. It's difficult to imagine that if Japan can't close a deal like this, that anyone can close a deal like this.
Do you think the Biden administration has been consistent with industrial policy? On one hand, talking about America first in some ways and talking about unionization, but not necessarily celebrating the fact that the United States is pumping a record amount of oil, which has really offset a lot of the prices and kept gasoline low.
I think they've been as consistent as you can be as a policymaker in this environment. A couple of points there. First, we have started from a very low point in industrial production and manufacturing. We gave away that base in the 90s and the first part of this century. Reclaiming it is going to take a long time. The report that the National Economic Council and the National Security Council put out in June of 2021 quantified how far back the U.S. is. The president then sought to make up a gap there. Congress joined him. This has been a bipartisan effort, particularly in infrastructure. So we are way behind the ball when it comes to, in the U.S., when it comes to infrastructure, when it comes to chips, semiconductors, we have a long way to go. Deals like this have to be reviewed from all of those perspectives we talked about. But ultimately, what's best for the U.S. in terms of short-term supplies and then longer-term building out of the industrial base. That's part of the president's proposal in the emergency supplemental. Almost $60 billion for a defense industrial base, $3 billion of that to build more submarines.
And you bring up chips, and that's where I want to go, because you think about the U.S.-China relationship, obviously still a lot of tensions there, a lot of that playing out in the semiconductor arena. But when you look over the totality of 2023, how has the U.S.-China relationship evolved?
It has stabilized, and the optics are better against the backdrop of severe competition. Competition across a lot of platforms, and that's not going to change. We see that almost daily. We saw it this week in critical minerals. And so when China decides that it's not going to allow the export of processing technology for critical minerals, that's a shot across the bow. It again points to a deficiency in the U.S. industrial base, and something that it's hard to make this political. If you look at it from an economic standpoint, of course, people will make it political, but making up for the deficiency will require decades, not just years.
Well, in the context of critical minerals and, of course, the news that we saw this week, both on that front and also that U.S. Steel Nippon deal, you talked about Japan as a strategic ally here. And when you think about the arena of critical minerals, and, of course, the competition going on there, how important does that make Japan and potentially other partners?
It's that last part, Katie, potentially other partners. Japan is critically important. There is no Indo-Pacific strategy, which is important to this administration, without Japan. And that goes back to my saying, if Japan can't close deals, then no one can. But it's the other players. What we saw at the beginning of the APEC week that didn't get a lot of attention was a national security partnership signed between Indonesia and the U.S. The U.S. sends defense technology, defense know-how. Indonesia promises to send critical minerals eventually. It's part of a very sophisticated program. Sophistication is necessary given how far back the U.S. is, in my view.
Taking a step back, you've gotten plenty of accolades for your research and for your view forward, particularly when it comes to politics, which recently has been a black box of absolutely impenetrable predictions. But I'm wondering next year what you see as some of the bigger market-related risks stemming from Washington, D.C. at a time where there's a lot on the table, not just industrial policy.
I think there are big four. The first quarter will be consumed by fiscal policy. What does Washington do around funding for FY24, and what does it do about the supplemental requests around wars? I think that morphs into first, second quarter. What's the result of the Fed's business over the last 2 years? How does that play into the economy? Normalization at this part of the cycle means tightening. Normalization soon will mean the other side. That leads into, in my view at least, concerns about liquidity, both official liquidity and private liquidity. It is it's the topic very few people want to address in public, but something that pops up on a regular basis as a concern among traders all the time, both official and private liquidity. That morphs into the back end of the year and the elections and what's happening in terms of the outcome of the election, what that implies for the country going forward and for policy in 2025.
And just in terms of the market risk there, meaning that as liquidity tightens, people will be more focused on that and the potential deficit and the potential inability of the U.S. to spend and all of those issues.
Well, that and the issues around federal home loan banks, the administration is constrained the advances that they can make to member institutions. There's discussion about paying less for reserves at the Fed and forcing that money out into the economy or somewhere else. And as QT goes on, we have a lot of tightening of liquidity in the system to follow.
Kim Wallace, thank you so much for being with us. Wonderful to see you in person. Kim Wallace of 22V Research, thank you. And Katie, I am right now looking at the Fed's balance sheet. It has fallen to $7.7 trillion from a peak in April of 2022 of almost $9 trillion. So that's some significant declines, 1.2 some trillion dollars of coming in at a time where they're also raising rates. It kind of creates this issue. Do we understand how to game out the influence on markets from that decline in liquidity?
The influence on market and the messaging, of course, we talk about and maybe poke fun at Jerome Powell for his communication missteps, but I do think it's going to be an interesting and potentially challenging needle to thread. You're cutting rates, but you're continuing to tighten via the balance sheet. How do you square that circle, and how much does that truly matter?
Well, that's what we just heard from Marvin Lowe, that he was concerned that the Fed is going to start cutting rates before they finish their quantitative tightening. So that's the wrong policy to go at. This has been one of the big questions going into next year, especially at a time of deficits. Right now, doesn't seem to be that much worry right now, given the fact that yields have come in more than a percentage point. I mean, really, the idea that they've come in 1.15% percentage points since the recent peak in October for 10-year yields, 3.86%. That reduced the U.S. deficit a little bit. Let's see if they can keep that going. New York crude up about 1%, $74.69. Coming up next, we've got Julia Coronado of Macro Policy Perspectives as we await that key core CPI or PCE, data. This is Bloomberg. From the most important data point of the last trading week of the year. And that's what it feels like. There's another week coming after this, or so I'm told. Right now, we are looking at markets really kind of at stasis after a pretty tumultuous couple of weeks. S&P futures basically flat down maybe a tenth of a percent, but what we're looking at is still hovering around that 4,800 mark, 47.93. The Russell 2000, honestly, to me, has been the highest flyer, the most interesting of all of the pairs at a time where people seem to be shrugging off, Katie, all of the growth concerns.
Absolutely. That's playing out in the Russell 2000. You think about those small cap companies that really have just been getting hammered when we've seen previous episodes of growth scares, but they've been the outperformer. I am really interested to see how this market changes in about 2 hours times. When we get those PCE figures, it is very much holiday trading conditions, not a lot of liquidity to be found.
Which means we could get some pretty big moves at a time when we've seen at least some stability in the treasury market compared to the recent volatility. 2-year, 10-year, 30-year, just seeing sort of this persistent bid in as we assess some of the weaker aspects of the market. I am thinking about Nike. I wonder how much something like that can really color people's perspective. 10-year yield 3.86%. I would say the 2-year yield 4.3%. Really a market shift lower as people price out the idea of 6 rate cuts next year. We're looking at the lowest 2-year yield right now, Katie, going back to May of this year.
It is just amazing. And if the equity market is overbought, what do you call the bond market? Because the rally that we've seen over the past 2 months has just been breathtaking to watch.
Which is part of the reason why people are interested in the fact that we have seen a little bit of divergence in the past couple of days between bonds and stocks. I do want to finish on currencies, given the fact that we are seeing dollar weakness pretty much across the board. Euro strength crossing that 110 line for the first time going back quite a ways. We got back down to 106 after a while, and we've really seen steady euro strength. How much is this because of European strength? I don't know. The data not necessarily coming in all that strong, but it really is the dollar weakness story, which could be something of, I don't know, a surprise heading into the beginning of next year. Look right now at the euro, the strongest going back to July of this year, Katie.
Well, it was exactly a week ago where we were sitting here with Damian Sassower, and I remember he told us over and over again about the dollar smile theory. Of course, the dollar does well when things are really good and when it's really bad. And if you think we're in the middle right now, maybe that means continued dollar weakness from here.
Dollar smile for me. Dollar smile for Christmas holiday. Under surveillance this morning, the U.S. announcing new plans to target banks that facilitate payments for Russia's military-industrial complex. It's the latest move by the Biden administration to try and restrict Vladimir Putin's ability to fund Russia's invasion of Ukraine. Treasury Secretary Janet Yellen saying, quote, "We will not hesitate to use the new tools provided by this authority to take decisive and surgical action against financial institutions that facilitate the supply of Russia's war machine." Gotta be honest, Katie, I've been reading a lot about the sanctions on Russia. I don't know how effective they've been. Frankly, all of the companies that were told to get out of Russia, or that were required to as a result of sanctions, had to sell their remaining businesses at fire sales. And you know who capitalized? Russia, who took the mochaccino and made it like, a mochaccino, and then they sell it under the same basic umbrella.
And you think about where Russia stands right now, basically it's been able to continue to get new weapons, etc. So that would suggest that maybe those sanctions aren't as effective as many would like them to be in the Biden administration. Of course, we're approaching the 2-year anniversary. It makes sense at this point that the Biden administration, the Treasury, etc., really looking for more ways to make that pain felt by Russia.
And maybe direct some of the money to Ukraine because it's not coming from Congress, at least not yet. Nike shares, meanwhile, tumbling. The company announcing it's looking for as much as $2 billion in cost savings after issuing weak forecast for the second half. The sportswear giant said sales in China fell short of expectations, while the company's CFO added there are, quote, indications of more cautious consumer behavior around the world. Nike shares down severely, 11.5%. You could see Puma, you could see Adidas falling in tandem, as well as Foot Locker and a whole host of others. I do wonder, we always ask this, how much is this specific to Nike? How much is it specific to a particular slice of the Chinese consumers that they sell to versus a real macro story that maybe is what Patrick Harker was talking about with her weakness?
Well, to the theme of the morning, those growth fears, I think the fact that, to your point, you do see a lot of competitors falling right now, Adidas, Puma, et cetera, suggests that at least investors are worried that this isn't just a Nike story, that this is an industry-wide story. And when does that industry-wide story turn into something that shows up in the broader economic numbers?
And maybe they're worried because there's nothing else to worry about. So maybe it's just used to.
I think it's December 27th.
Yeah, I think so. I think you're right. This one caught my attention, as I'm sure a lot of parents also read this, with conflicted feelings. Headset leading an $80 billion sell-off at some of China's biggest online names after the country imposed new curbs on gaming. China's top gaming regulator published draft rules aimed at clamping down on practices that encourage gamers to spend more money and time online. It's the latest crackdown from Xi Jinping's administration, which has long fought to curb gaming addiction. We can see Tencent shares down 12.4% and a whole host of others. I have mixed emotions here. On one hand, not really for censorship. I kind of think you kind of have to live and let live and give people that opportunity. On the other hand, as a parent, right, I don't know, if someone just took away some of the games and prohibited them from engaging with certain platforms, it would make my job easier. I understand that maybe I should just put better.
Maybe it would boost productivity, so to speak, but you can see really the surprise of these draft rules coming out in the share reaction. Really painful memories of 2021, of course, the last time we got that really broad-based China crackdown on the tech sector. I believe Tencent, that's its worst move lowers in one day since 2008, which we'll see if that's an overreaction.
Well, two things. One, this really raises questions about how much confidence people can have to invest in China's tech sector after it's really underperformed the U.S., given this kind of unexpected interference.
Mm-hmm.
But two, it raises a question on the commitment of Xi Jinping to the culture versus the economic backdrop of the country. Because for a long time, he's been kind of trying to push the culture aspect more, even at the expense of the economy. And now there's a feeling that maybe there's a little bit more of a push-pull, but not that much. And that's what this really shows, that still the cultural aspect reigning supreme on some level.
I think that's also why you're seeing this big reaction in the shares, because, it seems like the narrative that has started over the past couple months or so, of course, everyone came into this year expecting this to be a really great year for China's economy, or at least better. That hasn't been the case. There was some talk of maybe that would force Xi Jinping's hand, but just looking at the news this morning, it doesn't appear to be the case.
Meanwhile, we are about 2 hours away from the key data point of the day, which is core PCE. Joining us now, Julia Coronado, president and founder of Macro Policy Perspectives. Julia, what do you expect us to see at 8:30 today, and how much will it matter?
Well, I think what we're going to see is the consensus on our Bloomberg screens is a little bit stale. I think we're going to get a flat reading on core PCE inflation, the Fed's preferred gauge of underlying trends, and that will take the annual rate down to 3.1%. These are numbers that we already sort of had a foreshadowing of from the CPI and then the PPI, and even Chair Powell cited the 3.1% number in his December press conference. So I think the market has largely absorbed that information. Nonetheless, seeing that codified in the official data, that's the annual rate would be 3.1%, but on a 3-month and 6-month annualized basis, we're going to be just below 2%, the Fed's target. So really, it looks like the inflation beast has been slayed. Again, not calling total victory yet, but the signs are that the inflation dynamics have really exited that pandemic. And I think the things that you were just discussing with Nike and consumer finickiness shows that consumers are back in control of pricing power. That pandemic wave of pricing power that companies enjoyed is gone, and now they have to offer consumers deals to get them to part with their money, and that's good news for inflation, good news for the prospect of Fed rate cuts in 2024.
And the fact that consumers may be back in the driver's seat here, does that lead to deflation? I keep thinking about that warning, if you want to call it that, from the Walmart CEO that we got a few weeks ago. Are we going to start seeing retailers actually lower their prices?
Yes, so we are seeing that on the good side, and that was good foreshadowing from the Walmart CEO. We have seen that in the data. Finally, we are seeing some reversion in the price levels, so not just prices are not just stopping going up, but they're actually falling. We see that in cars, but we're also increasingly seeing it outside of cars. We're seeing that in a broad range of goods. That doesn't mean broad deflation, because services inflation continues to be the driver, which it tends to be the pattern that we saw pre-pandemic. Mild goods deflation and services inflation that on average leaves us around 2%. So I think that's the world we're back in. We may actually see a little bit, especially during the holiday season, more of that pressure on the price level. So outright price declines in electronics and in big ticket items in particular. But they're coming from very, very high levels. So there is room to fall.
And Julia, just spinning that thought forward, of course, we're also at 10 a.m. getting those University of Michigan sentiment readings as well. And even though we've seen a bit of an uptick when it comes to some of these sentiment surveys, still at pretty depressed levels, taking a historical perspective. But if we did start to see retailers maybe lowering their prices, maybe on the good side, things getting a little bit less expensive, what would that mean from a sentiment standpoint?
Well, I think we would probably continue to see that sentiment recover. We have had this conundrum of low sentiment and fantastic economic indicators. And that seems to be, that disconnect seems to be a uniquely U.S. phenomenon. And we can sort of wonder why that is the case. At the end of the day, though, consumers have been spending. So sentiment is always a very reliable behavior. As long as consumers have jobs, they will spend. Exactly how much they spend and with how much they lean into the holiday, et cetera, is certainly up in the air still. But they are spending. Hiring is on track, so we still have that positive feedback loop. But at least the U.S. economy, there's more global weakness. Nike cited China. The UK numbers didn't look so great. So globally, there's a little bit more weakness. The U.S. has been the leading economy of this cycle and continues to be. We've been boosting our Q4 GDP tracking as the data come in yet again, and it still looks pretty solid.
Julia, as far as headwinds for next year, I am wondering about the potential for a weaker dollar, which is not what a lot of people have been expecting, but we've been seeing. Does that raise a specter of importing inflation, or not at least importing disinflation, which is essentially what's gone on with such a strong dollar?
Yeah, the dollar has certainly played a role in contributing to some of the easing in inflation that we've seen, but it's not the primary driver. I think the primary driver really is the normalization of supply chain operations globally, and that continues to look pretty good, with the caveat of what we've been seeing in the Middle East. But overall, still a much smoother picture for goods flow. And commodity prices just, yes, dollar weakness could put some pressure, but generally speaking, that was the dog that didn't bark in 2023, right? Everybody came in thinking China reopening, upward pressure on commodities. We're in a new regime of globalization that's going to be putting upward pressure on commodities. Just has not materialized. So input costs are subdued. Supply chain pressures are fine. So I don't really see a resurgence of goods inflation should the dollar weaken. The dollar weakening seems to me, I would think, to be mostly tied to expectations for easier Fed policy. And again, the Fed has some room. The Fed moves so aggressively, they have a little bit more room to cut than some of the other global central banks.
Julia Coronado, thank you so much, and Merry Christmas, Happy New Year. See you in the new year. Thank you for all of your contributions to surveillance. Julia Coronado of Macro Policy Perspectives. She's talking about the likelihood of actually killing the beast of inflation. And this is basically right now the consensus trade. The Bank of America Fund Manager survey that came out earlier this week showed that 62% of respondents expect bond yields to fall.
Mission accomplished. There you go.
Yeah, you buying it?
At least 62% of people are, if you think that's the truth.
And this is sort of going to be the key question as we wait for the data that comes out in less than 2 hours' time. Coming up, Javier Blas of Bloomberg Opinion on oil, especially with Angola leaving OPEC. What does that mean in terms of the integrity of the oil union? This is Bloomberg.
We think on the margin, commodity prices are likely to be rising from here, and there are a number of indicators to lead us to that conclusion. There are going to be a lot of geopolitical headlines in the coming years, whether it's elections or further issues or challenges around hotspots in the world. and commodities can help hedge against that.
That was Eric Knudsen of Newport Bourbon telling us why he expects commodity prices to rise despite some of the recent turmoil. Oil extending its biggest weekly gain in 2 months as Houthis escalate their attacks in the Red Sea. Angola, meanwhile, announcing its exit from OPEC, which has perhaps another significance. Javier Blas of Bloomberg Opinion saying that departure is more critical than it seems, writing, quote, it makes it more likely that Riyadh will have to let the UAE produce even more oil over time. The risks for OPEC start in Luanda, but ultimately end up more dangerously in Abu Dhabi. Javier, I'm so pleased to say, is joining us now. I want to start there. This was a sort of a significant move considering that it has been a while since any kind of member state left the OPEC union. What was the reason for why, and why is it so pivotal?
Well, Angola has been having a fight with OPEC, and particularly Saudi Arabia, about how much oil Angola can produce in 2024. Angola has been struggling with meeting his own OPEC target level, and Saudi Arabia wanted to reduce those targets. At the end, there was a big fight on the last OPEC meeting. Angola said they was not going to recognize the new production targets introduced for the African country, and ultimately yesterday announced that it was leaving the cartel. At first sight, you say, well, this is not significant, this is irrelevant, because Angola is a very small producer within OPEC, and actually cannot really increase production, whether it's inside or outside the cartel. But I think that to me is more interesting what he says about the battles that are within OPEC, the internal battles, and particularly the battle between the United Arab Emirates and Saudi Arabia. The UAE wants to produce more oil, has been fighting an internal campaign to get a higher quota. It got its way a bit this year, and I think that they are not done, and I think that over time they're going to be trying to push for more production within the OPEC limits.
If you zoom out, this is sort of set against the backdrop of the United States pumping a record amount of oil, more than 13 million barrels a day. Their increase in production has really outstripped anything we've seen in recent history from the OPEC members, and this raises a question: have some of the cuts of Saudi Arabia essentially subsidized the U.S. shale industry and forced the union to lose some of its market share to the United States?
That has been happening. I mean, you look at the production cuts implemented through the last year by Saudi Arabia unilaterally and OPEC in coordination among themselves. Those cuts have served to boost prices, at times close to $100 a barrel, and that has been subsidizing the U.S. shale industry. And perhaps more dangerously for OPEC, one thing that has happened over the last year is that both the U.S. shale industry has been growing production, but it has been making money and rewarding shareholders. This is very different to what the shale industry was a few years back, in that period of 2014, 2015, when it was growing production, but it was not making much money, and certainly it was not paying the shareholders. Now it's doing both. We can grow production and it can pay shareholders. It's more sustainable. The longer that Saudi Arabia and OPEC keep prices where they are, about $75, $80 a barrel, the more the U.S. shale industry is going to be growing.
And some people have made the connection between what we've seen when it comes to U.S. shale production and what we saw in 2014. Of course, the last time we saw a big episode of U.S. shale production strength, we saw OPEC really flood the market with crude to try to gain back that market share. Is there any risk that we see a repeat this time around?
The market, Wall Street, is really very excited about this theory. They flush the market where Saudi Arabia in 2024 will increase production, bring prices down, and therefore regain control of the market, kill that growth in the shale industry. I don't see that happening yet. I think that the Saudis are still confident that the analysis of the market is right, that the demand is going to be strong, that the non-OPEC growth will slow down in 2024, and that therefore they will be able to start increasing production over time. That means the Saudi production, the OPEC production. But I think that it's very risky, and it really 2024 is going to be a make or break year. Either the Saudis are right on their analysis of the market and the slowdown in US shale growth materialize, or therefore they have a problem, prices are too high, and therefore they need to change the strategy. We're going to see it, but I think that doesn't come really until the second half of the year, and second half of 2024, and I believe that the jury is out on what scenario is most likely to happen.
So a lot to keep an eye on in 2024. Let's talk a little bit more about OPEC membership, because you point out in your column that, of course, if you look past over the past couple of years, Indonesia, Qatar, Ecuador, all making the decision to leave OPEC, and of course, Angola just this week. Do you see more exits to come?
Potentially, we can see some exits. I mean, there are a number of countries within OPEC that one wonders what they are exactly doing there. I mean, but their production is insignificant in the global scheme. I mean, thinking about countries like the Republic of Congo, or Equatorial Guinea, I don't think that they gain much from the membership. Perhaps more important, looking at the membership of the OPEC Plus group, that enlarged group of allies that work alongside Saudi Arabia. We saw Mexico still participate on the meetings, but it doesn't take any production action. We'll be keeping an eye perhaps on Kazakhstan, a country that has really struggled to meet with any production cuts mandated by the OPEC Plus group. But as I wrote on my column, we have to be very careful about not really rushing the obituary of OPEC. I think that the three most dangerous wars in the oil market, the three wars that could get you completely wrong, is to see OPEC is there. don't say that yet. The debt of OPEC has been really grossly exaggerated.
I love the three most dangerous words in oil is OPEC is debt. The three most dangerous words in investing is this time is different. That's four words. But I'm just, Javier, looking forward, I am wondering if the conclusion maybe underpinning everything that you're saying is that even if it doesn't forward, there's going to be a lot of pressure not to cut production too much, and thus that there's going to be a lot of supply that's going to pressure prices for the foreseeable future.
I think the focus for 24 is supply. How much oil is coming from the United States? How much oil is coming from Brazil? How much oil is coming from Guyana? Also, keep an eye on how much is going to be from Canada next year. I am more concerned about the supply for a source of instability for oil prices than the demand. I know that a lot of people are worried about global oil demand growth. I see that as doing fine. Probably we're going to get $1.1 million a day extra in 2024. That is within the normal that we are coming back to what historically was normal. 1 million barrels a day plus of incremental demand that has been the average of the last 20 years. The increase in 2023 of more than 2 million was because of the recovery from COVID. We're back to normal, but I don't think that global oil demand is in any way weakening significantly.
Javier Blas of Bloomberg Opinion, thank you so much for being with us. Always wonderful to get your perspective and some insight and what not to say. Okay, let's not say that.
I'm going to put that on the naughty list. Do not say that.
Exactly. You know, I gotta say, yesterday we were speaking with Frank Aquila of Sullivan Cromwell, and he was talking about the merger and acquisition backdrop. And he was talking about how the medical consolidation that he expected was significant. We're already seeing some of it. This just out from the Wall Street Journal that Bristol Myers Squibb reached a deal to buy a neuroscience drug developer, Karuna Therapeutics, for $14 billion. This is basically Bristol paying $330 a share in cash for Karuna and his experimental schizophrenia drug, which is now up for U.S. governmental approval. I will just say, okay, you might say, I don't know any of those drugs. It's not Ozempic, so what's the bigger trend? Doesn't really get into it. But here's the thing. This is interesting to me because it goes to exactly what Frank was talking about. That essentially you need a bigger suite of drugs because any one of them needs to pull their weight at any given time, and the generic sort of cycle takes off the revenues pretty quickly. So you need a big pipeline. The way to do it is consolidation. You are starting to see it after a year that basically has been somnolent when it comes to all that.
Exactly. Yeah, you think about that stat that we tried out yesterday. Globally speaking, falling below that $3 trillion mark for the first time since 2013. It's going to be really interesting, of course, when we start to see consolidation in the medical space, in the energy space. We're starting to see that already. What that portends for 2024, especially if the Fed does actually cut rates in a meaningful way. It feels like that's going to hold up for a lot of different industries.
So that's why they're cutting, right? But again, it's goes to this question: if they're cutting because people are feeling bad and the weakness.
So maybe you band together, pool your resources, and weather
Help each other. Maybe that's what we're going to see next year. Kumbaya. Coming up next, Kumbaya with Eddie Ordeni. Eddie Ordeni research. He's been talking about the roaring 20s. He has gotten it right, at least for 2023. How about 2024? At a time where there are great expectations for immaculate disinflation. Right now, we are seeing not a lot of action to end the week. We're seeing basically a flat S&P. 10-year yields, 3.86%.
So then the question would be, what more does the Fed need to do?
The Fed is likely to cut next year, but every time the Fed announces cuts, the market doubles those cuts.
The reality is the Fed may get us to a higher landing, but the markets have to adjust to that, and they haven't. If the markets are rallying, that's okay with the Fed. The Fed doesn't have to push back on a rally because they don't like a rally. I do think the Fed could have fairly back.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramoy. 1年の感謝を込めて、買っていただけのお祭りだ。200円ポイントバック。今ならお得に見放題。FOD 大感謝祭。上品な価値は当たり前。
90 minutes until the most important moment of the week. Good morning from New York City, worldwide. Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrell, Lisa Abramoy, Tom and John, both off today. Katie Greifeld, very much in. Thank you for being with us.
I was waiting for this call. It's great to come back this morning.
All right. Well, I'm so glad that you're here. It's always a wonderful thing. I'm curious what you're looking for. In about 90 minutes, we get core PCE, the most important data point arguably of the week, and heading to the end of the year.
Is it this continued march lower in inflation? What did we start to see here? Of course, when we heard from Jerome Powell last week, I thought one of the more interesting things he said is that he doesn't necessarily expect the last mile of inflation to be that difficult. That had really been one of the themes of this year when we think about the economic community. We haven't really seen that so far in this led to 2%. At least Powell thinks it's going to be smooth sailing.
Really echoing what we heard from Treasury Secretary Janet Yellen just days before. What we're seeing right now is PCE, core PCE, is around 3.46%. Currently, the expectation is for it to come in at 3.3%, and that's down from a high in February of 2022 of 5.6%. So a big way. Can we get all the way down? And this comes along with this question of, okay, but does it come down with the ongoing strength that we continue to see in almost all the indicators and earnings as well?
And does that really affect how people feel about this economy? I mean, this is one of the running themes that we've been talking about is that people are still miserable. You've seen that in the sentiment surveys, even with the tick up, we're still historically depressed. That's because the absolute level of prices is still super high.
Maybe it's just because we're all addicted to social media.
So we're all on TikTok.
Just looking at horrible images and trying to
Carpal tunnel.
exactly. So it's a really good, wonderful, beautiful thing. Good morning. Anyway, taking a look at markets right now, we do see a little bit of just a range-bound stasis as we head into the 27, up just a hair, but still eking over that 110 line to the highest for the year, the strongest euro versus the dollar going back to July. And this is not coming because of European strength. I think that's important. Katie, this is an indication that the U.S. cut rates into strength, and the European region is not going to, just simply because that is not the rhetoric out of the central bankers.
Yeah, you've seen that divergence when it comes to the rhetoric from the Fed, from the ECB. How long that's sustainable, maybe before the ECB has to bend to what the Fed is doing, that feels like the playbook that typically was, but at least right now it's been to the benefit of the euro, the fact that you do have that goal.
And meanwhile, what you are seeing in the U.S. is a real consensus trade that you are going to get inflation lower. The last level difficult, and that yields coming in, and 62% in the recent fund manager survey done by Bank of America found that they expect yields to go lower next year. And you're seeing a price action about 3.86% on the 10-year. Here's what we're looking at for the day ahead: 8:30 a.m. personal income and personal spending, as well as drumbeat, the PCE core deflator. This to me is the key indication that the Fed watches it and may hinge off of this disinflationary narrative to continue with their thoughts about rate cuts, whether they admit it or not. 10 a.m. new home sales, as well as University of Michigan sentiment survey. They'll also be getting forward-looking projections for inflation expectations. Does sentiment start to pick up? And Katie raised a really good point, which is sentiment has been very depressed. Do we see that start to shift, especially because oil prices are down? This tends to track pretty inversely with oil prices and gasoline prices, but also because if you take a look at the sort of mood, particularly with markets, it's making people feel a little bit more holiday spirits.
Yeah, it'll be interesting to see what that means for markets, for the economy when we do see sentiment pick up. Julia Coronado made the great point to us that it's been a really unreliable predictor of consumer behavior.
Which is the reason why I guess Jonathan Farrow tries to dismiss it. Today, the Treasury markets are closing at 2 p.m. because they got the message and are happy about the holidays. Stock traders can stay in their seats until 4 p.m. So we will figure out whether they will eventually get on board and close early as well. Joining us now is someone who's gotten it right all year. Ed Yardeni, president of Yardeni Research, called for the roaring 20s, is leaning into that now, talking about disinflation. We're seeing it now. What keeps you up at night, Ed, considering that so far you've gotten a lot of things very right?
Well, I've been sleeping pretty well, quite honestly. I guess I do worry about the Middle East, the geopolitical situation, the fog of war. You never know how things unfold once a war starts. And we have this fairly contained, localized war in Gaza, and that the risk is that it becomes a regional war and it affects the price of oil. But so far, the price of oil has been telling me that there's not going to be a regional war going on here anytime soon.
So putting aside some of those tail risks, is the risk in your mind that people aren't bullish enough, considering that everyone's been upping their expectations for end of the year targets, but we're catching up to it really quick already, and it hasn't even been the end of the year?
Yeah, I think that's true. At the beginning of the year, I was talking about 4,600. That wasn't bullish enough. We're already above that for the end of this year, and then I'm looking for 5,400 next year, and now there's more people talking about over 5,000. And then for 2025, I'm talking about 6,000. So I think I'm bullish enough. I don't think things can get much better than that. So that's kind of at the top end of the scale and optimism, I think. But I think in the near term here, we've got everybody seems to be too happy, at least in terms of the sentiment indicators. So that's on a near term basis. I don't lose any sleep over it, but I do watch it.
And with only, a week or so left until 2024, the fact that everyone is maybe too happy right now, is that why you haven't boosted your year-end target for this year? I believe that was at 4,600, and we're pretty firmly above that right now, Ed.
Yeah, well, I don't fine-tune my forecast that much because we are, as you said, we're only a week away, so what's the point of getting cute about it? Instead, I am talking about 5,400 by the end of next year and 6,000 after that, so that just puts me in the bullish camp pretty clearly.
Yeah, if I, of course, had to put out these forecasts, I think I revise on December 30th every year and just nail it every single time. But I do want to talk a little bit about 2025 because 6,000 is a staggering number and 2025 feels very, very far away. What is the work that gets you there, and how do you project that with a certain degree of confidence?
Well, first, on a short-term basis, looks like there's still some what I call die-hard hardlanders who think that we're going to have a recession next year. I've been talking about a rolling recession for the past 2 years, and I think in the next 2 years we'll have rolling recoveries. Clearly, we're starting to see a rolling recovery in the housing market. I think we've bottomed in terms of retail merchandise. A lot of inventory is piled up. Now I think consumers are going to go back next year and buy some goods in addition to services. And I think commercial real estate will be in a rolling recession in this coming year. But then beyond that, I think there will be a recovery. So I think that's the way I look at the business cycle. Is sort of spread out. But most importantly, I think we've got a labor shortage, significant chronic labor shortage. I think companies will use technology to increase productivity dramatically. Right now, we're averaging about 1.8% over the past 5 years. I think by the end of the decade, we'll be looking at 3.5 to 4.5%, which sounds far-fetched, if not delusional, I admit. But that's the way productivity boom cycles have gone in the past. This one should do the same.
Does it worry you at all? And I realize that anecdotes can't tell entire stories. You can't extrapolate out an entire research paper from one particular example. But let's take a look at Nike. They came out and they said that they're going to be cutting workers. They're going to be having cost cuts. And it is because, yes, they are working down their inventory, but because of weakness and weakness that they expect to continue going forward. Does that kind of contradict some of your optimism about the recovery of the retail space?
Yeah, well, that's a good point. And that's why I think a lot of forecasters missed the past couple of years and had this attitude that or view that the only way inflation can come down in the United States is if we have a recession. You mentioned the phrase immaculate disinflation, and I think that's what we've had. We've had inflation come down without a recession. And the reason for that is because the Chinese and the Europeans have done us a great favor. They've had the recession. So on a global basis, particularly China has been exporting deflation. And their PPI is down on a year-over-year basis. Even their CPI is down a little bit on a year-over-year basis. So I think the United States is going to benefit from the recession, the property depression in China for a long time in terms of having low inflation. And I think Europe starts to recover from its shallow recession next year, which will help us on the export side.
And let's bring this conversation to the bond market because the reversal that we've seen there has been stunning. And of course, you've done a lot of great work on deficits, what that means for bonds and the demand for bonds. And it felt like for a while, maybe the bond vigilantes were reappearing. Why did deficit concerns seem to fall off the radar?
Yeah, I've had the point of view for many years that I'll care about the deficit and the bond market cares about the deficit. In the past, supply really hasn't been much of a problem because you get the biggest supply in recessions when the Fed was cutting interest rates. We had this brief period where the bond vigilantes saddled up and started to move on concerns of fiscal excesses, and that period didn't last very long. Basically, from August to October, we saw this monstrous increase in the 10-year bond yield from basically 4.25% to 5%, and here we are back below 4%. I think there's an expression: "Don't fight the Fed." Maybe we should also say, "Don't fight Janet Yellen." Now that she's at Treasury, because she very cleverly cut back on the supply of long-term bonds and notes and issued a lot of bills. And the bond vigilante said, "Oh, if that's the way you're going to play the game, we can live with that." Meanwhile, I think the big story has been how inflation's come down. I mean, it's been only the past couple of months that the consensus really has become that we can't have immaculate disinflation. Even Fed Chair Powell in his press conference seemed to indicate that, we may actually get it.
And everybody let out a collective cheer, and you still hear that cheer today. And your Denny Research, Merry Christmas, Happy New Year, have a wonderful, wonderful end of the year, and thank you so much for everything that you've been giving us through the year in terms of insights. I am just looking right now at the forward-looking expectations for inflation baked into Fed funds futures and baked into break-even rates. Break-even rates now, 2.13% when you look out 5 years forward, so between 5 and 10 years out from here. Shocking.
There you go. And of course, we're going to get a read on what consumers and actual people about in terms of their inflation expectations. That's going at 10 a.m. in that University of Michigan release 1 year out and 5 to 10 years out. The 1 year inflation look ahead currently at 3.1%. That is the expectation, at least.
If you are just joining the program, we can see a little bit of a range-bound market, maybe a little negative inflection, but really nothing to write home about. 47.95 lower, just a touch, but basically flat on the S&P. Coming up at 8 a.m., we've got Joe Quinlan of Merrill and Bank of America Private Bank as we parse through some of the investing themes heading into 2024, what the consensus trade has been, what it will be. I honestly think that right now the consensus is that we're going to get to disinflation. It's going to be steady. It's going to be accompanied maybe with some bumps. Those are all viable bumps, evidently, because we heard everybody say buy the dip yesterday. And then we'll trot forward and somehow move to the next phase of the cycle with maybe a recession that's very shallow or no recession at all. That's the consensus, it feels like to me.
And it's pretty amazing. Again, you think about this time last year, it feels like everyone said that the recession is coming in 2023. Of course, some people were bandying about the idea of a soft landing, and then that turned into kind of a meme. Everyone was making fun of it. And here we are a year later, and it looks like a real possibility.
Which maybe is the reason why Kim Wallace of 22V Research maybe said the most interesting thing so far in terms of the lack of liquidity as the balance sheet keeps coming down as some of the effects of some of the higher rates come through the system. Do we start to see liquidity issues both on the public and on the private side?
Definitely one huge thing to watch. That balance sheet hasn't really made much of a bite yet. Maybe that changes in 2024.
Coming up, we're going to be speaking with Bloomberg's Michael Shepard in Washington on myriad issues going on both domestically and internationally. This is Bloomberg.
夫は選ぶ。それもたくさんの中から。
妻はこだわる。美しさを追求する。豊富なラインナップと
洗練されたデザイン。
住宅設備の三和カンパニー。
stand on its own, to stand on its own strongly, militarily, economically, democratically. That's why President Biden's supplemental budget request is so critical, and why we'll continue to work with Congress to pass it.
That was U.S. Secretary of State Antony Blinken speaking in Denmark as the two countries signed a defense cooperation agreement. Blinken highlighting the need for more Ukraine aid. This comes as the U.S. does announce some new sanctions on banks found to be facilitating payments for Russia's military-industrial complex. This, according to Bloomberg reporting, it's the latest move from the Biden administration to curb Vladimir Putin's ability to fund Russia's invasion of Ukraine. Michael joining us right now, Michael Shepard, executive editor, joining us now from Washington, D.C. I do want to get your sense about how much this move to sanction certain financial institutions is sort of a makeshift way to try to bridge the gap between Congress funding Ukraine in the new year.
Well, the timing of this certainly looks to be more than a coincidence. Congress left town earlier this week, as you noted, without passing this very critical funding package that the president had asked for back in October. It would have been $60 billion in new money to help fund Ukraine's war effort, and they just couldn't get it done. There were disputes over the border, and that has held it up until early next year. So where that has left Joe Biden is looking for another way to go after Russia and try to somehow slow Putin's role as he is gaining, if not ground in Ukraine itself, but at least gaining momentum.
Do you get the sense that there is enough critical mass to actually get some sort of additional aid passed for Ukraine in the new year, or is this going to really drag out beyond what Ukraine can handle in order to keep up their counteroffensive?
That's a great question, because what we're seeing is lawmakers saying that they will take it up in the new year. Before leaving town, Chuck Schumer on Tuesday told reporters, including some of ours up on Capitol Hill, that it was just a difficult issue to get agreement on. And it's not just the Ukraine aid. The support remains high on Capitol Hill and in the American public. When you look at surveys taken nationally, they still support Ukraine's war effort. The trouble is, a number of lawmakers, including some Democrats, are wondering whether we need more border security. More needs to be done as a record number of migrants come here. So that has been the issue standing in the way. They will have to get this done when they come back the week of January 8th, with only 10 days before another big deadline where they have to enact a funding package to avoid a government shutdown.
And I definitely want to get to that government shutdown. But when it comes to the border, you mentioned that has been a hurdle when it comes to actually getting this Ukraine aid passed, despite broad support still. How high is that hurdle, though? When, of course, Congress comes back and this is back being debated, what does that compromise, what do those negotiations look like?
Well, part of it, Katie, right now boils down to who will blink first, in a way, and who will be willing to give some more ground. Republicans are sensing a political advantage right now. When you look at even Democratic cities like New York and Chicago and Los Angeles, they have been inundated with new arrivals, people seeking shelter, people seeking asylum, and it is costing those cities a lot of money. New York is reporting that it will incur a deficit of as much as $7 billion in the coming year. So the pressure is real, and the pressure is being applied to the Biden administration. Democrats, however, find that some of the Republican measures for now, the ones that they are calling for, are too restrictive and too harsh.
And of course, those discussions will be complicated if the government does indeed shut down. And when we think about the past year or so, it's been defined by these last-minute deals that averted at the last minute. Is that the playbook that we should be expecting this time around?
It's already last minute. By the time January 8th and 9th roll around, when the two chambers get back into town, they will have almost no time on the calendar to actually get one of these spending packages through. And that means they will have to put together something very quickly on the fly. And it runs the risk of upsetting some of the hardliners and new House speakers, Mike Johnson's Republican majority, and they will hold his feet to the fire. And if he doesn't meet their demands on spending or on social policy in one of these spending packages, he could be in trouble.
Meanwhile, we've been talking about Ukraine and some of the aid there. When it comes to Israel and aid for that country, how much is there a little bit more dissent within the president's own party as we head into the new year, and as the president's own ambassadors have been basically encouraging Israel to take a very different tact in the new year?
Well, that's right. On Israel, we are seeing the administration putting more pressure on Benjamin Netanyahu's government to ease up on the offensive it has been waging in Gaza since the attack in October by Hamas. What they are finding is that it has been heavy-handed and not targeted enough against Hamas officials, with far too many civilian casualties. The U.S. is backing now a resolution in the UN Security Council calling for a ceasefire, and this escalates and echoes calls by the administration directly with all this diplomacy we've seen from Antony Blinken. Now, what that means for aid is that it's a reflection of misgivings, especially within Biden's Democratic Party, over giving additional aid to Israel at this time.
And I want to bring you a Quinnipiac University poll that I'm sure you saw, but I thought this was very interesting, that the poll found that support for sending financial aid to Israel to fund the war with Hamas is quickly deteriorating. In December, 45% of registered voters said that they want more aid for Israel. That is down from 54% last month. How does Biden, the presidential candidate, handle this issue?
Okay, that's a great question. And when the Quinnipiac poll came out the other day, that was when we were looking at the results, that was one of the things that really stood out to us, that this could be an area of vulnerability for Biden within his own party. In other words, that may mean that voters are less enthusiastic about the president as they head to the polls in November, if this conflict and if those misgivings last that long. We are a long way from the election, of course.
A long way from the election. I'm sure it's pretty much all we're going to be talking about next year, though. So let's talk a little bit more about it right now. Of course, Donald Trump seems to be, of course, the GOP nominee. When do we start to see other GOP hopefuls start to drop out?
Well, the first big tests are coming up next month. On January 15th, we have Republicans' first nominating contest in Iowa, and that will be a test of whether Trump's efforts there to score a decisive victory have paid off. He is really looking to put so much distance between him and the next two second-tier candidates, Nikki Haley and Ron DeSantis, that there is no way for them to catch back up. Nikki Haley, however, is gaining some ground in New Hampshire, which holds the nation's second nominating contest, the primary there on January 23rd. And what we could see is that if she keeps it close or somehow even pulls off an upset, that could change the state of the race a little bit heading into the third primary, and that's in her home state of South Carolina later in February.
Bloomberg's Michael Shepard, thank you so much, as always, and wonderful to see you. Have a wonderful new year and happy holidays. Coming up next, we've got Deborah Cunningham of Federated Hermes, but before we do, I got to say, as I was thinking about the sort of political season next year, I don't know, I'm curious about which narrative is actually going to end up being the driving force, given that right now we're talking geopolitics, but almost always it comes back to the economy and to domestic issues. And it's going to be really a different scene potentially on that front.
Exactly. I mean, you think about the average American voter and its domestic concerns, the economy that really tend to trump most things there. So it'll be really fascinating to see. And of course, that conversation around third-party candidates, we didn't get to it with Michael. It happens every cycle, but it is especially happening this cycle when you think about the likes of course, Robert F. Kennedy Jr., et cetera. And when it comes to the GOP nominee, as Michael said, Nikki Haley has been gaining some ground.
Yeah, but still kind of dwarfed by Donald Trump. I do think it's interesting with Robert Kennedy. When I was looking at some of the poll numbers, he's pulling voters from both Trump and Biden, and it's pretty significant critical mass. It's not a small amount of voters. That said, how much of this is really just protest voting? When you talk about the actual polls that are inconsequential, people can just sort of feel angry and express it. It's kind of what we've been seeing in other polls. It seems like there's a lot of anger out there right now.
Exactly. When you're actually in the ballot box in November, I think that, of course, that's the only thing that matters. These polls at this point, a little less than a year out or so, how much do they actually portend for what the actual result will be?
We're going to read on anger coming up today at 10 a.m. with the University of Michigan Sentiment Survey. Maybe people will be feeling a little bit less angry than they have been, or at least not very good. Right now, we're basically seeing a very quiet market, 47.96 unchanged in S&P futures. Euro dollar, to me, this is really interesting, crossing the 110 mark for the first time since July.
T ポイントと V ポイントが一つになった。青と黄色の V ポイント。
60 minutes till the most important data point of the morning, core PCE deflator. That is the key metric. It sounds so exciting, but it's the key metric the Fed watches to understand where we are in inflation. In markets, it is a quiet day to start the week, or to end the week, I should say. It feels like we're ending the year right now. S&P futures, NASDAQ futures basically going nowhere. Russell 2000, a little bit of a lift up, almost 0.1%, which has basically been the way of the morning. In the bond space, you are seeing a bid. This, to me, has been the most consistent theme. And Katie, I really am watching this closely to understand, can we end the year 3.85% on the 10-year, bang in line with where we started it?
It would be really poetic, right? I mean, after all the turmoil, et cetera, that we saw this year, we were really obsessed with the deficit, for example, for a hot minute. To end right where we started would be pretty amazing. Not obviously the case when it comes to the equity market. Quite a rally.
The fact that the Bank of America Fund Manager Survey that came out earlier this week showed that 62% of all fund managers surveyed said that they expect bond yields to fall. This is the consensus right now pretty much out there, and that's what you're seeing in the bond market.
Well, when do they start to migrate out the curve? Because we have $6 trillion or so sitting in money market funds, the very shortest dated paper. It could be an incredible move, or maybe they're happy with 4 to 5%.
It kind of depends on rate cuts, which is the reason why we're watching the euro versus the dollar. The euro strengthening to the most strongest that we've seen going back to July, crossing that 110 figure, 110.34 versus the dollar at a time where people are expecting the U.S., the Federal Reserve, to cut rates more aggressively, maybe, than the ECB, even though the ECB maybe has more reason to cut, given some of the more dismal data coming out of the region.
Yeah, and if you take a look at what the market expects, basically the same amount of rate cuts coming out from the ECB and the Fed, but they do expect the ECB to go first, or at least that was the balance when I checked a couple days ago.
But it could shift given the fact that people seem to be kind of toggling between those two. Under surveillance this morning, core PCE due out in about an hour. A Bloomberg survey of economists predicting the index will fall to 3.3% in November from 3.5% the previous month. The data may bolster expectations of Fed rate cuts next year after data Thursday. Yesterday suggested the economy is cooling. We did see that revision downwards in terms of GDP, as well as that revision downward in terms of inflation for the third quarter. To me, my real question is, what's the balance of risks in markets, right? An upside surprise or a downside surprise? What would be the most disruptive right now, given how much disinflation and rate cuts have been priced in?
Well, it'll certainly be fun to watch the lines at 8:30 a.m. because it feels like everyone just rushed to one side of the boat. It's very heavy at this point, the positioning that's really been put on in the past 2 months. It picked up again last week. So the bar is pretty, low here for some sort of big move, especially when you think about it's December 22nd.
Exactly.
Keep checking that.
So just to make sure it's December 22nd.
It is.
Yeah. Thank you for that check. All right. Elon Musk, meanwhile, blasting public markets, saying indexing has gone too far. His latest rant coming 3 years to the day since Tesla joined the S&P. In an interview with ARC's Cathie Wood, he said pressure from shareholders limits company efficiency. Musk said keeping SpaceX private has allowed him to take more appropriate risk compared with Tesla, and that he wouldn't recommend companies go public, quote, unless they really have to. He also, I believe, talked before about Twitter, about X, and how it's really nice that it's not public. I bet it is for him. I bet it is.
I would think so. And of course, this happened on an X Spaces. I don't know
exactly.
You tuned in. I did not, but I saw a lot of the people I follow were. There's actually some really interesting pieces in here. We know that Elon Musk doesn't love passive indexing. He's made that point before. But the comments on staying private, of course, that's been helping him out with Twitter. But to go public, there's a lot of annoying homework that comes along with that. The fact that you have to basically give out your report card 4 times a year. Not every company would want to be in that position.
I love the opposite, though. Then he said it did allow Tesla to access public funding.
Exactly.
Which is exactly the point of going public. So, to a certain degree, okay, how much is this great thing about the fact that shareholders can be a pain in the butt, and how much is this basically they have to be held accountable versus remaining private, taking a longer-term view? But he's not alone. Other people have a similar kind of feeling that if you can have a longer-term view, it's better than short-term kind of fixes for shareholders.
And think about the IPO market over the past 2 years. It seems like a lot of companies have really agreed with that logic and applied it to themselves because we know there's companies in the pipeline that just don't want to come out yet,
especially on evaluations that might be a little suppressed based on some of the volatility we've seen this year. Meanwhile, the FDA is seizing thousands of counterfeit units from Ozempic, from the U.S. drug supply chain. The regulator advising wholesalers, pharmacies, and healthcare practitioners to double-check the information on the products they've received is they haven't been tested for quality or safety. Demand for the blockbuster weight loss treatment soaring in recent months. The manufacturer Novo Nordisk saying they expect shortages continuing next year into Europe. Off-market brand Ozempic that people are buying, they found that there were some side effects, but they were simply in line with other side effects from more on-brand kinds of things. Are there going to be people basically going to alleyways? Do you have any Ozempic shots? I need to know.
I think it's happening. You listen to public discourse and everyone, it seems like, wants to get their hands on Ozempic, but they can't. Supply is really constrained. Not to make light of the situation, does fake Ozempic work? It has the same side effects. Does it have the same actual effects?
Are we going to really end up basically advertising fake Ozempic? Because essentially, it does seem like it has a similar kind of side effect. But this raises this question about the barrier to entry and how much other companies are going to try to follow suit with similar types of drugs. We saw this from Eli Lilly. We saw this from others that are trying to get in, considering how hot the drug has been and how a lot of people are, indicated for it.
Oh, yeah. It's basically a gold rush that's going on right now. It feels like a lot of these drug makers are trying to come up with their response to Ozempic, their own type of Ozempic, because, it's been one of the stories of 2023, that and artificial intelligence when it comes at least to the stock market.
So we can all be skinny and basically outsource our thinking to computers. Joining us now, Deborah Cunningham, Global Liquidity Market CIO at Federated Hermes. Not on that at all. Deborah, thank you so much for being with us. I want to start with this idea that people have been talking a lot about cash on the sidelines. And we've talked about this before and how cash on the sidelines are going to start flooding into risk assets. Have you seen any evidence of that over the past couple of weeks?
Not really, Lisa. It's not something, generally speaking, people at the end of the year are trying to, kind of allocate and close out their books in a normal fashion. And there may be some surprises, either cash inflows or cash outflows. Things close, things don't close how they're supposed to. But ultimately, it's not a great time in a normal situation for, what I call reallocation. That happens more at the beginning of the year. So we have not been experiencing or seeing that type of market shift at this point and cash flow out.
Well, I do want to get to what happens at the start of next year and in 2024, but I know I just said that AI and Ozempic have been really the stock market stories of this year, but I want to add a third thing, which has been the rush into money market funds. Of course, one of the big stories in markets this year, about $6 trillion sitting in money market funds right now. Where is that coming from? Is that investors saying, look at these high yields, I'm going to go there? Or is that people moving away, taking money out of their bank deposits, for example, and shifting into money market funds?
I think the bulk of it is coming from the deposit market. It's coming in as a retail trade, so it's a pretty steady trade. And if you look at what shifted out of retail deposits during the year, it's been about 1.3 trillion, and about $1 trillion has gone into money market funds. So it's hard to follow dollar for dollar exactly where cash goes. But from all we can tell, I'd say at least 80% of that is coming from the retail deposit market, where rates from a banking perspective just didn't follow short-term rates in the market upwards with the Fed. Now, there has been in the last quarter, just really since we flipped into the fourth quarter, October and November, a little bit more of a cash flow from an institutional type of customer, and I think that has to do with the flattening to some degree inverted yield curve, where the shorter end of the curve is no longer as attractive necessarily as what a product that has some weighted average maturity like a money market fund does. So we're starting to see some of that trade. I would expect to see more of that trade though in 2024.
So just to meditate on that point a little bit longer, that potentially 80% of what we've seen come into money market funds has been coming from deposits. How sticky is that money? Because it feels like one of the assumptions is that what we're seeing in money market funds that belongs to the equity market, that belongs to risk assets, and it's going to return there. But if it's coming from bank deposits, that logic doesn't quite make sense.
That's exactly right, and certainly there are some risk assets that are in there as a hiding place, a short-term home until they feel like their entry point back into their risk asset class is more palatable for them. But that's certainly not the bulk of what we've been seeing. Now, maybe that will pick up again in 2024, but it's not been what we've seen mostly in 2023. It's come through the deposit market, through the retail trade, with the likelihood of that being very sticky. And I think the other thing that makes that a stickier trade than it has been even over the course of the last 15 years is we, as well as the market, and I don't think anybody out there expects the Fed to normalize at zero, where they have been, 12 out of the last 15 years. The expectation is the normalization is back to, 3.5, maybe 4%, depending upon where inflation plays out. And so that again keeps that retail trade generally in the market rather than back in deposits.
So do you just sort of reject, Deborah, this idea of cash on the sidelines flooding into markets once the Federal Reserve has cut rates 1, 2, 3, or even more times next year?
I don't reject it at all. I just don't think it's all coming out of money market funds. I think cash continues to come out of deposit products, and I think some goes into the direct markets through that, from that mode. And I do believe there will be some that comes out of money market funds, but I certainly don't think it's it's the vast majority of what will let's say fuel the markets, the risk asset markets in 2024.
Just real quick here, Deborah, are you seeing money go out of short term and go into longer term? Is that a theme?
It started, we run micro short and ultra short funds that are really just, a modest step out the yield curve in the 1 to 2.5 year sector. And we're starting to see positive cash flow in those products, but it's trickling. It's certainly not any kind of a flood.
Deborah Cunningham, thank you so much for being with us. Merry Christmas, Happy Holidays, Happy New Year. Deborah Cunningham of Federated Hermes, we appreciate you being with us. And that's what we've been hearing from a lot of people, that yes, there is a lot of cash out there, but it's being put to work in short-term debt financing. If you are just joining the program, you can see markets aren't doing much today. It is sort of sleepy ahead of that really important indicator coming out in about 45 minutes time. S&P futures lower by less than 0.1%, 47.95. I will just say, did you catch this, Katie? In the Financial Times, they did an interview with outgoing Morgan Stanley CEO James Gorman, and he was saying that markets are really going to take off once the Fed starts cutting rates. He said the shock of the rate increase recently has put a damper on banking deals and capital markets deals. That is because everybody doesn't really know what the cost of financing is. That changes if the Fed starts cutting rates.
And of course, it really depends what market you're talking about. Of course, that makes sense for deal making, that the Fed finally cutting rates, those financing costs coming down, would see a big resurgence there. But the equity benchmark level really hasn't. I mean, it's already priced in at this point. It's going to be interesting to see what the catalysts in 2024 are. I would assume it's going to turn into how many cuts we actually get.
I love this from James Gorman, who just has days left as the CEO before he hands over his reign to Ted Pick. He said that the banking system had become much safer in his 14-year tenure, leaving, quote, their own stupidity as one of the biggest threats still facing banks, maybe a little tongue-in-cheek relative to some of the March turmoil.
So they'll find some way to make their lives difficult. It sounds like
we see that in March. I mean, that's sort of part of the issue.
Yeah.
There's a mismatch in maturities and the deposit base and the consolidation of the deposit base in particular industries versus the duration of some of their assets.
The money market funds, it's very full circle.
Exactly, especially if they're actually paying something and banks still are not paying very much on their savings accounts. Coming up at 8:30 a.m. The key economic indicator of the day, plus Michael Deepin weighing in on that of Bank of America's securities. And right now, quiet market as we finish up one of the last weeks of 2023.
Here's the thing.
Over the summer, dipped down in airline traffic, and especially domestically. And we saw the domestic focused airlines lose money. Heading into December, the numbers have come off a little bit. Waiting until later because Christmas is Monday versus middle of the weekend. And so you're seeing people getting ready to travel rather than traveling.
That was Elaine Becker of TD Cowen on the state of travel this past summer. And of course, leading into the Christmas holiday on Monday and then New Year's Eve right after that, a lot of people going on vacation. And this is definitely a sort of personal issue for me where I'm always sort of rooting for the worst. I've had a lot of horror stories over this particular break.
Yeah. I hope you weren't flying Southwest last year.
No, but I did once catch the last plane out of JFK before it was closed down due to a snowstorm. So, and then that was after being delayed for almost 24 hours with an hour. But nonetheless,
You got out.
I did get out, and it was a little bit traumatic. Okay, so this is where I really want to get a sense of where we are heading into this, what kinds of disruptions we can expect, how people are paying for their travel, and whether they are traveling. Brian Kelly, founder of the Points Guy, who did advise that I get rid of my points and spend them. Thank you for that. Trying to work them down. What do you expect in terms of this particular holiday season? Are we going to see another Southwest episode? Are things looking like they're pretty orderly? Are people going to have a not really deeply uncomfortable experience?
Well, I'm an internal optimist, and things are looking really good, right? So the Thanksgiving holiday in November, we saw the most amount of air travelers ever, 2.9 million go through the TSA, and things were pretty smooth. And the biggest factor that I see would be weather. And right now, there's no major weather patterns that I see that could upend our air travel system. So I'm forecasting hopefully smooth sailing for the next 10 days. We had 2.5 million people through the TSA yesterday, relatively low delays and cancellations. So fingers crossed, but I think this is going to be a good holiday travel season and certainly much better than last year.
Especially given some of those delays. International, though, does face some potential headwinds, in particular some of the strikes that we've been hearing about in the United Kingdom, elsewhere in Europe. Is that on your radar at all, or is that basically just sort of hand-wringing as people have to find something to worry about if they're not eternal optimists like yourself?
Yeah, anytime you travel to Europe, you have to worry about strikes. They can happen any day. It's much different here than the U.S. But in Spain, there will be strikes with Iberia's ground staff around the New Year holiday. Yesterday, we saw the Eurostar kind of surprise strike that displaced a lot of people. They're actually not even selling trains today between Paris and London. So overall, there might be some German train strikers here or there, but hopefully no widespread strikes that we're aware of.
And so how should travelers think about that? Say that they do have a holiday European vacation booked. I mean, should they be thinking about insurance here, or how to best handle that?
Yeah, so what most people don't realize is when you use your premium travel credit card, as I'm assuming many people watching this program do, whether that's Amex Platinum, Chase Sapphire, Capital One Venture, those cards come with built-in perks. And this is what people don't realize. I was traveling to Puerto Rico in May, and my flight was delayed 10 hours by United for a mechanical reason. United gave me a $100 e-gift card, told me to go away. And American Express refunded $500 for me to get a hotel, to get Ubers, to go out to dinner in Old San Juan. So always go to your credit card company for compensation. And when traveling to Europe, there's a rule called EU 261 compensation. And if you're traveling to or from Europe, and there's a flight delay for pretty much any reason, they are mandated by the government to give you compensation. So yes, go to the airline, but generally the airlines are pretty cheap when it comes to compensation. Your credit card is where it's at. The only time I really recommend travel insurance is if you're going on that mega trip on a big expensive cruise line, safari, you're bringing, people who could get sick abroad where you might need that evacuation coverage. So, but generally your credit cards protect you a lot more than you realize.
Yeah, so maybe you actually should read the fine print there. But what are you actually seeing in terms of where people are going when it comes to this holiday season? Are they going abroad, or is much of the travel that you're seeing booked and happening right now within the country?
Yeah, I mean, most of the travel growth we're seeing is international. It's funny, I was looking up where are the deals for, I was just searching from New York, and the best travel deals were in Miami and Orlando. And a year or 2 years ago, we all knew Miami flights were like $2,000 each, crazy rates. So we've seen some of that demand from domestic travel now. We're seeing huge increases. United Airlines just started flying nonstop from San Francisco to Christchurch, New Zealand. They're betting big on the Pacific region, new flights to Tahiti. And so I think there are a lot of travelers who now feel comfortable traveling internationally, doing that big trip. Japan, I'm going there in February. We're seeing huge increases in that type of travel. And also when it comes to lodging, we're seeing a huge increase. Hotels.com saw 125% increase in authentic lodging. So whether that's a ryokan in Japan or staying at a riad in Morocco, I think travelers are sick of paying for overpriced cookie cutter hotels and are willing to shell out for those luxury experiences.
Are they looking for discounts, or is this still very much the experience world that's just continuing? And is this basically a sea change that has legs, where experiences will keep seeing people pay up for some of these unique experiences, even if they don't buy a shirt and an outfit that's fancy to accompany it?
Yeah, people, funny enough, discounts are happening domestically. JetBlue just ran a $50 off fare sale. Southwest, so the domestic airfare market, those carriers are struggling, where the premium cruise lines that are just launching, there's tons of new, really exclusive ships. I just did expedition cruising is huge. I'm seeing more and more of my friends go to Antarctica. I just went on Swan Hellenic to Greenland, and that was an incredible experience. So yeah, people are shelling out for unique, bespoke experiences. That sector of the market cannot grow fast enough. And even domestically, theme park travel is big. Disney still continues to see growth. It's not just Disney. Dollywood just increased prices and opened up new parts of their park in the town. So people really want to take their families not just to a beach vacation, but they want to go and experience the new Mattel theme park that just opened up in Arizona. They really want these unique experiences, and that's a trend that I think we'll see happening more and more.
And Brian, you are the points guy, so let's talk about some news that broke this week. It was first reported by Reuters, basically about the Department of Transportation in the early stages of looking into airline frequent flyer programs, really checking whether airlines have engaged in unfair or deceptive practices when it comes to some of those programs. What do you make of that?
Yeah, I think it's much needed. A lot of times there are changes that happen overnight. And, it can be said that the airlines are banks nowadays. The airlines are making more money selling their currencies and frequent flyer programs to banks. So I do think there needs to be a little bit more consumer heads up, right? If you're going to have this multi-billion-dollar loyalty program that essentially is a bank where, you're creating your own currency, you should give consumers notice when making negative changes. We saw this year Delta and American Express rolled out some pretty punitive changes to their credit cards, increasing fees, etc. And there was huge consumer backlash to mostly Delta on that one. And we saw them roll back some of their changes. Now, do I think the government needs to come in and regulate every aspect of loyalty programs? Probably not. But having some more consumer protections when those negative changes happen, I think are a good thing for everyone involved, because people are getting sick, just constantly changing and moving up the goalposts.
And waiting in line at the lounge. That might be part of the issue. Yeah, Brian Kelly, thank you so much for being with us. Brian Kelly of the Points Guy, thank you. As always, as we all envy his life in having all these bespoke experiences in Iceland. And
I want to go to Japan. That sounds really nice. You said I was going there in February?
Yeah, you're going to try to join along.
I was going to go to the Olympics in Tokyo, and then COVID happened, so it didn't work out for me. Never been to Japan.
Well, this is something that is sort of indicative of where we're at, because a lot of people, I guess, are looking for some of those experiences more. Coming up next, we've got Joe Finlan of Merrill and Bank of America Private Bank, looking toward that key indicator coming out in about 35 minutes' time, core PCE, the core PCE deflator, that indicator that the Fed looks at, the balance of risks right now. And this is something we've been talking about. Is it that if we get an upside surprise, that raises questions about disinflation? Or is it a downside surprise that turbocharges people's conviction in the trade that's already been happening?
We think about the potential of an upside surprise, and the conversation we had with Martin Lowe at 6 a.m. this morning, saying that it's a credibility issue for the Fed, that if they are going to cut, they do not want to hike again.
Meanwhile, in markets, we see basically not a lot of activity. Why would we, given the fact that there isn't that much going on, and potentially things could be upended in about 35 minutes' time? The euro gaining versus the dollar, 110.19.
FOD なら大人気ドラマをはじめアニメもバラエティも8万本以上が見放題。最新雑誌だって読めるんです。今ならお得。300名様に豪華プレゼントも。FOD 大感謝祭。上級なこともかかります。
Really hard to find that person who's very bearish. But I think the bullishness has a wider window to perform in going into
24 is going to be a surprisingly good year for the market.
I think we're going to feel a little bit of pressure on the big caps coming into the year. The risk is the recession the market is expecting doesn't happen.
This is Bloomberg Surveillance with Tom Gee, Jonathan Darrow, and Lisa Roberts.
The report comes in 30 minutes time. Good morning. Welcome to Surveillance. This is Bloomberg Surveillance. Jonathan Farrow, Tom Keene, Lisa Abramowitz, John and Tom are both off today. Katie Greifeld very much here. We are 30 minutes away from that core PCE data that really is the key inflation metric that the Fed looks at a time of incredible hope built on this disinflation narrative.
Absolutely. And you look at some measures, as Julia Coronado was telling us earlier, if you really torture the data on some measures, we're already back to 2%, that Fed's target, of course. But of course, when it comes to the headline numbers, et cetera, not quite there, but we've come a long way pretty quickly.
And yesterday, people were picking up the fact that in the third revision of third quarter GDP, it sounds pretty esoteric. However, within that, we saw the GDP price index actually revised lower at 3.3% versus 3.6%. And core PCE, this was core price PCE, came in quarter over quarter at 2.0% from the expectation of 2.3%. So already hitting that target at a time when people already had this enthusiasm. Could we see more of the same today?
Exactly. And how much is the risk that we do see too much of a good thing? Of course, the Fed has been very successful in engineering inflation down a lot more quickly than perhaps they expected, than the markets expected, certainly. And then, of course, you think about the bearish case becomes, okay, maybe they get a little bit over their skis here and we do come down much further than we thought.
Or it's because of growth concerns, right? And that's the other side of it, which is the reason why people are focusing on Nike coming out overnight, basically saying that they're expecting to take $2 billion of cost cuts and make that through cutting jobs, through cutting other expenses. The latest quarter, they were talking about $400 to $450 million charge, largely due to severance expenses. You're seeing those shares lower by about 12%, bouncing around. Not a lot of liquidity, pre-market now down 11%. We're seeing a kind of commensurate move in Foot Locker, in Adidas, in Puma, in a whole host of other retailers. And again, this sort of goes to the core of, is there more weakness under the surface? We heard about from the likes of Patrick Harker, and the kind of we're carrying other Fed officials onto as well.
And it's interesting in terms of signposting where we are in the cycle, because you think back a year ago, I think it was when you had all those big tech companies cutting jobs and getting rewarded in the stock market, as shareholders really wanted to see that cost-cutting discipline when it came to the business. Of course, now we're in a different part where people are worried about that slowdown, and this is just bad news.
Not that worried, though, if we talk to Edgar Denny. It's true. Like, yeah, I guess that doesn't really keep me up at night. I kind of sleep pretty well. Right now in market, it's not doing that much. And why should they? It's been already an incredibly volatile couple of weeks, a couple of months, and what we're seeing right now is a lack of action ahead of a key metric on inflation, 47.96 right now in S&P futures, euro 110.23 versus the dollar, crossing that mark to the highest, strongest levels, I should say, going back to July. 10-year yield is at 3.85. To me, this is just a shocking story of a round trip. And Katie, I love how you put it, basically, pointing to the fact that we're ending the year right where we started it, but it hasn't felt that way.
No, not at all. Again, I feel like the summer felt like a year in and of itself. Of course, that big trip up to 5% that we took on 10-year yields. So certainly everyone was worried about the deficit. They were worried about Treasury supply, just the supply of bonds coming to market. And just quietly, all of those fears were quieted.
And it comes at a time of some shifting winds from the Treasury Department, from the U.S. government, as well as on the expectation of disinflation. Joining us now, so please say Joe Quinlan, head of CIO Market Strategy at Merrill and Bank of America Private Bank. Joe, thank you so much for being with us. I want to start with just how much you've changed your view going into 2024 on the heels of the great Fed pivot.
Well, Lisa, I was more constructive on the market before the Fed pivot, and I'm a little concerned talking about clients about how optimistic they become. So you've seen the great run up since November. So we're still cautious and constructive on the markets in 2024 for sure, but maybe we pulled forward in 23 through the gains in 24. But we'll see. We still see a good economy, good earnings, and more upside as we go deeper into next year.
What makes you concerned, Joe, considering the fact that we don't necessarily have the risk of the Fed staying overly hawkish for a prolonged period of time, and we don't necessarily have signs that the economy is really slowing down much?
Well, the reason that latter point is key in terms of the inflation outlook. Inflation expectations have come down, but maybe we have an economy that just has a mind of its own, keeps plowing ahead, more consumer spending, keep the unemployment rate under 4%. We could revisit this idea that the Fed is going to pivot and maybe just go back on pause. That could be a head fake for the market, but in general, this economy continues to surprise on the upside, and that keeps that inflation play out there. You talked about earlier, the last mile, 2%. How adamant is the Fed going to be to get there, and how hard it's going to be? I think we part of the big things.
And Joe, I want to talk about how you position a portfolio against that backdrop, because you take a look at your notes right now, and I see that your sector preference is for energy and it's for healthcare. Of course, two sectors that are in the red this year. Of course, energy after 2 awesome years. You think about double-digit gains. Healthcare had a rough year last year as well. When it comes to that preference, is that just as simple as buying the laggards in this market?
Not really. In a sense that healthcare has some value given the pullback. Energy, we like commodities, hard assets, hard power, because I think something the market is now really focused in on is the geopolitical risks that are out there, whether it's Europe, the Middle East, Asia. If something springs up and we have this whole time of flu, we want to be more defensive
next year that is possibly going to look a lot like the one that some people expected for this year. I am curious about your view on U.S. assets. You do prefer U.S. assets over international ones. As at a time when we're starting to see some weakness in the dollar, does that concern you? Do you think that's going to be short-lived? Do you think that the dollar is going to strengthen again as you start to see some of the other nations and from the European Union kind of be forced into cutting rates?
Well, Lisa, when we talk about the dollar, to me, let it slide a little bit here against the euro, most other major currencies, because it'll be very good, beneficial for the big cap, large cap multinationals here in the United States. So, I'm not really worried about that just now. And, we look very carefully at the emerging markets, and China has had a rough 2023. It's better set up for 2024. We'll see. We can debate that a lot. In Europe, it's more scattershot. You want to buy the luxury brand leaders, a little renewables, later to the pipeline, insurance companies, life science companies, all sorts of things. But, the dynamic nature of earnings, growth, innovation, all roads still lead to the U.S. So we've got our built portfolios. That's where we start. That's our core. Is that go out and look at other parts of the international markets, more sector specific and real momentum.
Let's stay on the U.S. Let's talk about the U.S. bond market, because Lisa and I have been marveling at all morning. If you look at the 10-year Treasury yield, it has been a round trip in 2023 over one. How are you thinking about the bond market and the level of 10-year yields right now? Are we around fair value, or is this big over bond market?
Great question, Kate. So we talk about that with our clients and internally as well. The round trip has been quite dramatic here. Shorter duration, but that 60-40 traditional portfolio conversation as well with clients. But here, when it comes to the bond market, money markets in general, we're starting to see for the first time clients want to get out of the money market. They're actually having conversations saying, hey, we should be more in equities. How should we position? So I think one of the key messaging what we're seeing with our clients is like, okay, we got this cash, we want to back in equities, how do we do it? So I do think that $6 trillion in money market funds, that's going to be fodder for fixed income, high quality, short duration, and equities over the balance of 2024.
Joe Quinlan of Maryland Bank of America Private Bank, thank you so much for being with us. Happy holidays as you head into the new year. Right now, we're not seeing that much reaction in markets, but to me, this sort of caution around the edges seems interesting, and this is the reason why. If we get a downside surprise, is that going to be more of some kind of impact on markets, downside surprise for PCE, rather than an upside surprise, in the sense that there isn't enough bullishness? I mean, it sounds crazy, especially coming from someone who tries to find the skepticism in a narrative, but it seems to be something that's just kind of percolating out there.
Yeah, there still feels like this skepticism to this rally, even though we have seen the broadening out that a lot of people said that they wanted to see before they really felt good about this market. We've certainly seen that. But then you think about all the money in money market funds, at least a good portion of that is a safety net. Then you think about gold, for example. I mean, gold hit a record high, and it's like no one really talked about it. That point just in the past couple of weeks. So there's still a bit for evens out there, even with this big rally that we're seeing.
I've never talked about it because how do you understand gold? When do you ever get the narrative right?
I think it's physical Bitcoin.
I don't know. It's not controlling half the audience right now.
It's like Bitcoin but China.
You're just starting the program. The S&P is basically flat right now. We're looking at just below 4,847.96. Really, Katie? You're really going to do that? Is that basically your pitch for your Tuesdays?
I think I'm more than half joking, but I will say when people start describing Bitcoin as digital gold, it did start to make a little bit more sense why people were so obsessed with it. So
it also took some of the volume away from it. I don't know. I feel like gold is one of those things that people bucks kind of wake up every time there's some sort of threat, and sometimes it works and sometimes it doesn't. So I don't know. It's been a really hard one to go around.
I like to think about the psychology of different asset classes. Bond traders, they're classically pessimistic. They're very doom and gloom. That, of course, is the stereotype. But then you think about gold bugs, and it's totally different. Then you start to get into some conspiracy theories. I find that really fun.
Yeah, sort of like the Armageddon trade.
Yes.
Right now, one thing that's not the Armageddon trade, I thought the story was interesting. Tesla's designer came out and said that the Cybertruck's design kind of gives it an edge because it makes it kind of funky. I'm saying maybe a literal edge, because it looks like if you sort of brush past it, like strip or something. Which makes me think that probably if you parked it in New York City on the sidewalk or on the street,
can you drive it over the bridge? They're so heavy. No, I would love to. I think they're hysterical.
It's maybe not what they're going for. Coming up, I do want to say on Bloomberg Television and the radio at 11:40 a.m. Don't miss this. A really important conversation. Mel Brainerd, director of the Council of Economic Advisors, joining Bloomberg Television to give her outlook on the economy, on the budget, on inflation, and of course, some of the latest comments also hinged around U.S. Steel and its acquisition by Nippon. From New York, this is Bloomberg.
They're likely to test Western red lines, but they're not going to see a catastrophic response from the coalition. Remember that we
U.S. intelligence official Norman Rule speaking with us yesterday, as we do have this ongoing impasse between Houthi militants that want to continue attacking container ships and world trade as long as they can in the Red Sea, which does, of course, lead to some key shipping routes that account for 12% of global trade. Welcome back. We are looking at markets that are very quiet ahead of a key data indicator, or PCE deflator, that comes out in about 13 minutes' time. S&P futures kind of nudging into the green, and again, basically unchanged, 47.97. Euro versus the dollar, 110.24. Yields lower on the day. This comes after yesterday's gauge came in softer than expected from the third quarter revision. Third revisions of the third quarter of GDP. It sounds sort of esoteric again. Some people were saying this is the reason why markets moved. You're seeing oil prices just a bit higher. But to me, honestly, everyone's talking about the potential headwinds for next year. One of them is where oil prices go up in response to the conflict with Israel and Hamas war, as well as the Ukraine-Russia war. And then there's this issue now of some of the potential blockages in a key shipping route that doesn't seem to have easy solution.
Absolutely, we're talking about supply chains once again. Of course, you would hope that some of these companies, some of these shippers would be better prepared for this. But of course, after what we saw in the pandemic, but still some big implications when you think about the state of the flow of goods around the world.
So just to get a state of play and understand kind of what the potential risk scenario is and, how this might get resolved. Nick Wadums is joining us now. I think he's Bloomberg's national security team. Nick, can we just start with the state of play? We've already heard the Houthis vowing to be the attacks. We've learned of a coalition of allies to try to prevent it. What's actually going on the ground at this moment?
Well, in the last 24 hours or so, there has been a real sort of quieting down. We haven't seen any more Houthi strikes against shipping. That's in part, of course, because so many ships have diverted to go around the southern tip of Africa. So, the big question is the U.S. is in the process of pulling together this maritime coalition whose whole purpose is to essentially protect ships passing through the Red Sea. And the question is whether that's going to be good enough. Are we going to start to see ships deciding to route back through despite the potential danger from the Houthis? Because again, they haven't attacked. They've given no sign that they plan to let up when they see these ships again. So that's really what we're looking for, some statement of confidence or intent that would signal shippers are willing to go back through the Red Sea.
And so far, that's not happening, with hundreds of merchant ships being rerouted away from the Suez Canal into much lengthier passages to avoid this threat. Nick, there was a story in the New York Times that caught my attention about the potential for the U.S. starting to sell arms once again to Riyadh, to Saudi Arabia, and this being a potential kind of you scratch my back, I scratch yours, for their assistance in trying to help negotiate with the Houthi militants. Do we have any sense of where the negotiating chips are to get more Middle East partners on board with that?
Well, that's a great question. It's such a complicated dynamic. But essentially, look, you have a situation where there is a ceasefire, however tentative, between Saudi Arabia and the Houthis in Yemen. So the U.S. may be looking to reward Saudi Arabia for the fact that ceasefire is, to some extent, holding, saying, okay, we will send you these offensive weapons again. Sort of on the condition that you don't really use them against the Houthis at the moment. But certainly, Saudi Arabia is just so central to all the U.S. plans in the region. We can continue hopes for normalization talks with Israel, obviously, conversations on what happens next in Gaza, efforts to get the Palestinians on board. They just need Saudi Arabia for basically every major strategic initiative they have in the region. So this is sort of a nice little carrot for the Saudi government saying, listen, we appreciate your support. We're going to need a lot more of it in the months ahead. So here's something we can handle use of.
I think that's where I wanted to go. You mentioned the importance here of Saudi Arabia. How worried is the administration at this point that this could spill into a broader regional conflict?
Well, that is essentially what they say is their overriding concern. So obviously there's the fate of the hostages and the civilian casualties and the concerns about how Israel prosecutes the war in Gaza. But the bigger fear there really for the U.S. is, okay, how do we keep this thing from spreading? You have Hezbollah in Lebanon. You obviously have the Houthis, both backed by Iran. And the U.S. is very, very concerned that this thing will spread even further. Obviously, Saudi Arabia, again, completely instrumental, essential to U.S. plans to tamp things down. Maybe there are some back-channel conversations that are able to be had with Iran. There's also influence that Saudi Arabia may exert on other players that can in turn influence Iran. So, again, it's all part of this U.S. effort to keep things relatively calm. And the real feeling is that they're not sure how to do it. Again, you get that issue in the fear that more of the attacks really could pull the U.S. into Iran.
Well, Nick, to that point, Bloomberg News reported this week that the U.S. is considering military strikes against Houthi bases. What's the latest there on the idea that maybe the U.S. could shift from just deterrence to actually going on the offense here?
Well, what we're going to have to see there is what happens when ships start routing through the Red Sea again and what sort of intelligence the U.S. is gathering about Houthi intentions. Because everything that's been done so far has been, as you say, deterrence, defensive. So they're shooting down drones, they're trying to stop the attacks, but they're not hitting the Houthis at the source. They're not going after those drones and ballistic missiles in Yemen itself, and obviously doing so would represent a massive escalation and again feed to the spirit of a broader war. But that's something they're certainly weighing. But again, we're really going to have to see what shippers decide and whether they're going to push ships potentially in harm's way once again out of this coalition.
Meanwhile, Nick, especially as we head into an election season, we hear a lot about domestic threats stemming from some of what's going on in the Middle East, and thinking about some of the rhetoric that the border issues are deeply related to this because we're at a heightened risk of terrorists coming in through borders or other types of attacks in the nation. Based on your connections with people in the intelligence community, how much validity is there behind some of those concerns?
I mean, the border situation is a great question. My sense is that really they are just in pure, almost panic mode about how to stem the tide of migrants who are coming in from the border, and it's not so much a question of concerns about terrorism. I mean, that is a concern that's raised by some people, particularly among Republicans. Democrats in the Biden administration, I think, don't see that quite as much as a major threat, but they are planning to send Secretary Blinken to Mexico at some point in the coming days, as President Biden announced yesterday. They really need to figure something out with Mexico, and finally sort of getting to the point where they realize they need to do something about this. How they're going to be able to achieve that, though, that is the big question, and that's something they need to do.
Nick Wadhams of Bloomberg, thank you so much. Happy holidays. Have a wonderful new year. This really is the year where we're ending on a massive geopolitical bang in all the wrong ways. And frankly, next year, it seems like that's one of the big questions that's keeping people up at night, not because they can trade around, but just because of community issues.
Yeah, and it's of course a tricky moment for the Biden administration. Think about the fact that there's two hot wars going on right now in the world, and then you add what's happening to the Red Sea. On top of that, the potential to exacerbate one of those hot wars, and you add in the fact that next year is an election year. There is a lot for Joe Biden to keep an eye on, especially given the fact that there's a lot of disagreement with his own party and his own cabinet about how to handle some of these things. Like, it's not easy. We're dealing with two proxy wars, right? We're dealing with one proxy war with Iran, one proxy war with Russia. A lot of questions around how much the U.S. wants to get involved. What will potentially ignite an even broader war at a time where there's some very difficult, nuanced stances going on with Middle East partners and enraged kinds of rhetoric around the world. I mean, it really is quite a moment to try to delicately walk. And a delicate dance, too, going on with China, of course, the second largest economy in the world. Of course, 2023, we did see a little bit of movement on that front, normalizing that relationship, but that is top of mind for a lot of citizens and investors as well.
But even more important, inflation. Coming up next, we're going to be talking about that per PCE deflator that's going to be coming out. We are so pleased to say Michael Gabin of Bank of America is going to be able to help us parse through those numbers and understand the disinflationary hopes and dreams. Are they coming true? We are just seconds away from the last important data release of 2023. It is exciting. It is core PCE deflator. We're going to take a look at the key metric before the Federal Reserve heading into it. Just the setup is pretty quiet as people really have no reason to trade ahead of a key economic data point. What's notable to me today is the lift in crude up about 0.7% or $74.44. Right now, across the terminal, we are getting some of the data trickling in, and right now is showing, wow, the PCE deflator month over month actually went down. So it declined at 0.1% versus the expectation of being flat. That means that year over year, the PCE deflator came in at 2.6% rather than the survey expected 2.8%. And if you take a look at the core PCE deflator, year over year, you're looking at 3.2% versus the expectation of 3.3%. So a good downside surprise for those who are looking for disinflation. And what you can see is markets like what they see, at least around the margins. Not a massive reaction at this point. S&P futures basically unchanged, but really kind of confirming the disinflation that we have been talking about, seeing all of the other indicators. Just taking a look at the 2-year yields. You're not seeing a lot of activity, which maybe gives us a sense, Katie, that this was kind of expected and baked into the pricing going into this.
Yeah, perhaps it was priced in. Interesting, too, to not see, though, too much of a reaction. We'll see how these numbers settle in and the market digests it. But 2-year yield, a big beat there, 5.4%. Actual, the survey was expecting 2.3%. So certainly a surprise. You're watching the market try to digest all of this, and I will say that S&P 500 futures moving a touch lower right now.
Durham goods orders, you mentioned that, and I think it's kind of key components here. Not only are they almost twice or more than 20 expectation in terms of the magnitude of the increase there, but the prior month was revised upwards. It was lesser of a negative than originally across the board. The disinflation, but still economic strength, which really sets us up for this question of, can this continue? When we get this disinflation with ongoing strength, and we'll just give you a couple of the numbers coming in. As expected, 0.4%, and personal spending increasing 0.2%. That's a touch lower than expected, 0.3%. Downward revisions on personal spending for the prior month. Personal income increase more than expected the prior month. So pretty much, people are being responsible. They're not spending too much. Their incomes are increasing. Inflation continuing.
And with all that in mind, it's interesting to not see necessarily a positive reaction to these figures. Again, we're talking about small moves here, but you take a look at futures right now on the S&P 500. We're down 0.1%. Again, very small moves, but we were unchanged heading into this report. So it's interesting to see these narratives try to get parsed right now.
What gives? Let's ask that question to Michael Gateman, head of U.S. Economics at Bank of America Securities. Michael, what is your reaction given the fact that markets seem to be a little put off by consistently disinflationary data?
I think the markets had, well, first of all, good morning, Lisa and Katie. Thanks for having me on. I think markets had priced this in already with the CPI data in hand and the PPI data in hand. We can make a pretty good projection of where PCE should come in. And we did expect the headline to be down a tenth and the core to only be up a tenth. So this number really wasn't a surprise to us. And if you do the implied CPI forecast, prices are looking for pretty soft inflation over the next 3 to 6 months. So I think the market had largely priced in this number. As we all know, they're looking for twice as many cuts this year as the Fed has planned. So I think this is the status quo number for markets.
That might be status quo. The durable goods orders, Katie pointed out, not so much. It came in significantly higher than expected. And I wonder on the margins, there's some anxiety that it seems sort of incompatible that we get ongoing better than expected growth while still seeing that disinflation that everyone's been hoping for.
Yeah, there's certainly a limit to that, right? So far, the narrative is that the economy can cool, growth can remain modest or moderate, but away from recession, and we can experience both moderate growth and disinflation at the same time. That's our view. I think that's the Fed's view for sure, and why they shifted to say more balanced reaction function between bringing inflation down and wanting to support soft landing. But you're right, there's a limit to that. There is a risk to shifting to another stance now and coming out of the December meeting and tilting the outlook towards rate cuts. The markets have reacted quite quickly and financial conditions have eased. So the risk is that maybe you gin things up too much and you don't make as much progress as you want on the inflation front. So no free lunch in that regard. We think the Fed's in a good spot. We do think rate cuts are coming, but you make a good point. Too much easing in financial conditions can ultimately mean inflation is stickier to come down or maybe even rises a little bit and kind of puts off some of these rate cuts that the market is expecting.
Well, let's talk about just the magnitude of the rate cuts that the market is expecting. Of course, 150 basis points priced into next year. A big gulf between that and what we saw in the dot plot, just 75 basis points of cuts penciled. And when we take in totality what we learned today when it comes, of course, to PCE, to personal income, to spending, and of course, those durable goods orders, where does this land in terms of what the market is expecting? Do those 6 rate cuts look justified at this juncture?
I think the inflation data certainly support the idea that the Fed can start in March. So assuming the data flow trends in the way that it has, with a lot of evidence of disinflation and modest growth but a cooling economy, we do think rate cuts can start in March a little earlier than the Fed thinks. We would say, curb your enthusiasm a bit for 150 or maybe more rate cuts over the course of the year, because we do think inflation will be a little more slower to come down. So we agree on the start earlier than later, but our view is you get about 100 basis points of cuts. So the market may need to reprice some of these as the data comes in.
So, okay, maybe that process back to target will be slower than expected. Compare that to what we heard from Jerome Powell last week. He said that he was reluctant to say that the last mile of this inflation fight will be more difficult. Is that your expectation, or does slower than expected sort of imply there's some pain ahead?
No, I would agree that at least, again, the composition of the data flow that we've been seeing, I think suggests we can enjoy modest growth and disinflation, and it does suggest that the last mile may not be overly difficult, right? So that does come from supply side effects both on goods and on services, where reemployment has really helped increase services output. So we're getting a supply side effect there. As everyone knows, more goods have been falling for 6 months. So we'll see if things like shipping issues out of the Red Sea change that narrative. But otherwise, the last 3 to 6 months worth of data suggests maybe we can, it's more likely than not that we can get down to 2% consistent outcome without needing to generate significant pain in labor markets. Which would be a great outcome for the Fed, the average U.S. household, the average U.S. business. It would be a great outcome for the economy.
Well, I want to talk about that a little bit more, because inflation has been enemy number one from the Fed's perspective for really the last couple of years now. But now, as we continue to get this march lower when it comes to some of these figures, does the Fed's focus shift here? Do they start paying more attention to economic growth, to the labor market, et cetera?
Yeah, I still think bringing inflation down is the number one goal, given where inflation's been, where it is, and the Fed's internal consistency about, hey, we really control inflation. We set that long-run inflation objective. We determine long-run inflation outcomes. So it's kind of it's in their blood, so to speak, and in their DNA. So I still think that's issue number one. But a very close issue number two, if not closer to balance, is, hey, I think we can soft land this economy. We don't need to generate as much pain in labor markets as we thought we might have had to do 6 to 9 months ago. So we should keep an eye out for that. So yes, it does make an argument as so many cuts priced in, is both of those cases moving to a more balanced reaction function in an environment where the economy is cooling and inflation is slowing. That just increases the odds you're likely to get rate cuts. So I think the market is listening to that message.
Michael, what's the gap between just weakening that is good and weakening that is bad? And I ask this because I'm trying to still understand the language at the CFO's office at Nike when they said the demand is cooling faster than they expected, revised downwards some of their expectations for sales, talked about cutting jobs. Is this something that is just an idiosyncratic business overlaid with a weakening economy in a good sense, or is this potentially something bad?
Yeah, I think I would put that narrative probably inside the rotation story away from goods purchases back to services. The good side of the economy, the manufacturing sector, has been kind of on the edge, if not in a mild recession for some time now, at least in terms of production and inventory adjustment and so forth. So I think the good side of the economy is reacting in part to that rotation story. What still looks pretty solid is activity and employment on the services side of the ledger, which is 2/3 or more of output. So I think that to use your phrasing, the quote good slowing and cooling is about the rotation story, the end of the COVID reopening impulse. Things should naturally slow down anyway. We need to provide an environment for the economy to do that while we bring inflation down without stamping on the brakes too hard. So you're right, there's a fine line between slowing that we think should happen as a result of a very unusual pandemic-driven cycle, and oops, we've got the monetary policy setting calibrated incorrectly, it's too tight, we have to back out of it more quickly.
Does anything about the services inflation concern you, given the fact that it still is running above what you would expect for 2% consistent inflation?
Yeah, certainly shelter and kind of the structural issues in the housing market without a lot of supply and inventory and available homes to contract for sale or purchase. So the shelter story, shelter is moderating. It is coming down, but it's coming down more slowly than our models would have suggested. So we think that there's stickiness there. And even non-shelter services inflation has been more sticky. So this is where we would say maybe curb your enthusiasm. We have inflation for PCE coming down to around 2.5 year-on-year by the end of this year, where market implied pricing is closer to 2. So it's easy to see how a stickier inflation path means some of these rate cuts are not realized.
Michael Gabin of Bank of America Securities. Happy holidays. Thank you so much for being on with us. Right now, we're looking at markets trying to figure out exactly how to respond to a downside surprise when it comes to inflation coming in less inflationary or disinflationary than expected. Kind of range bound, bouncing around between gains and losses. But right now, to the upside, 48.02 on the S&P. If you are just joining the program, up about 0.1%. And I gotta say, Katie, what we just heard there from Michael Gabin is kind of what Andrew Hollenhorst over at Citigroup was talking about. He just put out a note saying that right now the slowing is largely due to goods, services inflation, and wage growth are running faster than what is consistent with 2% inflation. December core PCE will likely be much stronger, but Fed officials will likely still proceed with their plans to cut interest rates. So this is kind of the debate. Are there certain factors that are going to kind of roll over as the year progresses next year?
It's a great question, of course, one we're going to be grappling with for quite a while. I will say it is poetic. They take a look at 2-year treasury yields right now. They are unchanged on the day, totally flat. And that sort of gets back to the point that Michael Gabin was just making, that this was a pretty status quo number overall. Of course, you toggle with some of the details there, but overall, this is consistent with what's already been priced in.
And this has been a lot of disinflationary hope, and this sort of raises the question, again, of whether people have priced in that hope entirely in markets across the board, including stocks, where you have seen an incredible rally over the past couple of months, some of the biggest gains that we've seen going back years. What I'm hearing from Yolanda over at Renaissance Macro is something that I'm also hearing from Robert Sitch, which is core inflation right now, if you annualize last 6 months, is below 2%. So this is what people are looking at. Robert Sitch pointing out that core PCE annualized for the last 6 months is now 1.87%.
There you go. Maybe we'll get back to worrying about the fact that inflation's too low. That would be very 2018, very 2019 of us.
Yeah, that would be a throwback, wouldn't it? I think that would be quite a moment. Right now, we're not thinking about that as much as just getting to the end of the year and figuring out exactly how to reset for next one. Coming up, Adam Pickett of Citigroup on his 12 trades of Christmas this summer.
The Fed is going to need to see at least 2 or 3 months more of continued improvement. They're going to need to see sustained improvement before they're going to look people need to take more action. And so I think the market should expect that it's going to take a while and more sustained improvement before the Fed does.
That's all expected. Was Robert going forward to Fed president. Right now, people are very much banking on a March rate cut after disinflationary data comes out, one data point after another. Right now, we are firmly pricing in a 77% chance of a rate cut coming at the next meeting that comes in March. So that's where we're at right now. Right now in markets, you can't really see much action. I guess it's all priced in.
It's all priced in. The S&P 500, when it comes to futures, at least getting a little bit of a lift there, up about 0.2%. Not a huge reaction though when you consider that this was pretty good news, but to your point, maybe it was all priced in.
We did see, if you are just joining the program and missed it, we did see personal income come in bang in line with expectations, personal spending a touch below, but this really was the main course. We saw a negative 0.1% decline month over month in PCE deflator, and the core deflator year over year came in at 3.2% versus the expectation of 3.3%. I do want to just run through a couple stocks that we've been talking about all morning, because I think it is important to note. It's not that we're seeing no weakness, it's just that it's been isolated in specific sectors that have been rolling through recessions. Nike shares lower by 11.5% after coming out and saying that they're planning to cut costs by $2 billion in the face of weaker demand than expected, talking about job cuts, talking about other expenses that they hope to slash. Other companies, Foot Locker and Dick's Sporting Goods, among those in the US, and you also see Puma and Adidas over in Europe, all falling in tandem. And this real question of, okay, we've already seen the retail recession. Is it ongoing? Are we recovering? Is it China? Is it global? Is it the US? These are some of the questions that people are trying to parse through away from just some of the euphoria.
And you think about the ripple effects of, okay, maybe Nike has some idiosyncratic issues that are specific to Nike, but then you think about a Foot Locker, for example. It relies on Nike for a lot of its revenue. It sells a lot of Nike products, for example. So again, one chain's problems has widespread effects.
Especially because they talked about also just maybe paring back some of their models and, having a scarcity kind of situation to ignite some of the interest. Igniting interest is very much had a position for a year that promises to be tumultuous and that we've already seen a lot of one-sided buying. Joining us now, Adam Pickett, head of global macro strategy at Citi, who is feeling very Christmassy with his 12 trades of Christmas. Adam, how did you come up with certain pairs heading into the new year at a time where markets have moved very quickly and all in one direction?
It's a great question. I think for me, one of the key themes that maybe is going to take us out of that sort of big directionality that you talked about is thinking about where some of the divergences are really going to come in. Obviously, we've had a bit of a one-way move in risk and duration, but for us, trying to think about picking certain spots within the central bank stories is quite interesting. For us, looking at places like Australia on the more hawkish side, comparing that up against maybe the UK on the most dovish side, where we think sterling Aussie is a pretty good story. Rocky Stocky within the Scandinavian central banks is a good bull case as well. And we also saw some very divergent guidance from the SNB versus the Bank of Japan, where again, medium term, we think that buying Swiss versus yen also makes a heck of a lot of sense, given some of the guidance there. So if you don't want to be too directional, I think that's a good place to start. But obviously, we've got a lot of interesting stories going on with the US and the Fed as well.
And is through the FX market really the way to play that idea, this divergence that you're seeing in different developed market central banks versus, say, their bond markets?
We think so. We think there's additional stories around, say, the oil dynamics in Norway, in Swiss versus yen. Actually, a big part of the story for the Swissy is that really the SNB's influence on the currency has got nothing to do with rates. It's got entirely to do with the FX intervention story that is going on. Meanwhile, for the yen, it's a little bit of the BOJ story, but obviously it's got a very high beta to US 10-year Treasury yields, which again, we think medium term, there's a story there. So with that, we think that there are other influences that additionally help the central bank divergence story. Gold is another nice one for the Fed. They're taking away from the short rate dynamics and a little bit less priced than we think too.
Well, let's bring this conversation to the U.S. and to the U.S. equity market, because looking at your 12 trades of Christmas, I'm taking a look at trade number one, and that is sort of playing a expected slowdown in the U.S. consumer. What's the best way to do that?
I mean, for us, one way we think is maybe a useful way to kind of insulate yourself from the broad beta is to think about these kind of high quality names, still thinking with a little bit of a growth tilt, where ultimately these guys still have very, very high quality balance sheets, very high cash to debt ratios, and pairing that up against some of the smaller firms. So, even though there's maybe a bit of a lean towards the US consumer slowing down, ultimately we think US household wealth is exceptionally elevated. It's up around 35 to 40%, depending on how you look at it, versus 2019. And that still skews, we think, towards consumer discretionary, which has this nice mix of growth, but also sort of top line, high level spending power versus, say, the Russell, that could be the best way to play that theme of, ultimately we still have strong spending numbers as we saw today, but some of these lower quality firms are still going to be caught up in the credit cycle and the ultimate longer term slowdown.
Adam, I do want to point out that you are definitely multicultural. You were talking about 12 trades of Christmas, but you could have come up with a more succinct piece. The 8 trades of Hanukkah, although that's past. Adam, I'm curious if this is a good time to be trading in markets that are of thin liquidity, where a lot of people have already gone home.
Yeah, look, I mean, we sort of joke that a lot of the year-ahead forecasts are stopped out by the end of January. I think for a lot of people, their year-ahead moves have already happened, in the space of a few weeks. For us, one of the themes that could potentially still run, popular trade is something like the steepener in the US, but we like 530s quite a lot. Twos has already moved a lot. The twos 10s profile actually is quite punitive carry for us, something like 530s in the medium term still has further to go. The Sharpe ratio getting into that kind of trade 6 months before the first Fed cut is about as good as the 2s10s, but we still think it has a lot of legs. So exactly to your point, a lot of markets have moved, liquidity is thin. I think being patient, being creative with the construct of the trade still makes a lot of sense here.
Are more people in the office this year, given how much volatility there has been?
Absolutely. I mean, I've got a good friend of mine who will be in on Boxing Day, and I think we'll be far more staffed over the Christmas period than is normally the case. A lot of my team made probably one of the most active ends of the year that we've seen in a long time. So definitely a lot of interest still.
Adam Pickett, thank you so much, and happy holidays with your trades. Good luck. Adam Pickett there of Citi. Interesting to hear that there are going to be a lot more people in the office at a time where we've become accustomed to pretty incredible volatility.
I know you're smiling because you're off next week. You're out of here.
I am, but I've enjoyed this so much. That's the reason why. Thank you for being with us. Are you here next week?
I am here next week. It'll be working till the bitter end. Of course, I'm going to be doing my best Lisa, Tom, or John impression.
All three at the same time.
All three at the same time. I don't know. Maybe I'll switch every hour. We'll see what happens.
Like a skinny bow tie, or like a skinny tie, a bow tie.
Yeah, whichever. Maybe like a nice place.
No, just sort of, a sky's falling sign, just sort of march around to. But what if, and you can make it work. Honestly, it's been quite a year, and I will say that it's been really front-loaded. What he just said there, Adam Pickett, about the idea that the beginning of next year has already been front-loaded and brought to this year, which kind of sets up some interesting potential moves heading into the very bitter end this holiday.
And I mean, you think about all the things that were projected for 2023 and the things that we spent a lot of time talking about right now that we weren't this time last year to bring it back to the equity market. Of course, AI has been the thing to talk about. Weight loss drugs have been the thing to talk about. Maybe I was behind the ball, but those weren't necessarily on my radar last December.
Right, so what are we going to be talking about next year?
I shuddered at it.
Exactly, indeed. Right now in markets, not a lot of action. It's a very important data point, but what it did was just confirm what markets already had been pricing as people parse through it. A little bit more of a lift, 48.07 on S&P, up 0.2%. The euro gained versus the dollar, 110.28, the highest levels that we've seen going back to July. A little bit less of a bid into treasuries, 10-year yields at 3.87%. Coming up on Bloomberg TV and radio, do not miss this, conversation with the lead economic advisor to the president at 11:40 a.m., Lael Brainerd, director of the Council of Economic Advisors, at a time of incredible question around why people are feeling so bad if the economy is on a good trajectory. This is Bloomberg.
Is taking us to his village.
And we're going to get much further.
It's a 5-hour journey. At least, normally.
That's supposed to be the hardest bit, but see?
The Amazon rainforest has been through its worst drought on record. Its rivers, lakes, and streams drying up.
So you should be able to pass through here. Normally, even at the end of the dry season, but we're getting stuff.
Nunca tinha tido essa seca com essa proporção. Nunca tinha visto. Falei nem na história. Seca, mas não no nível que está agora.
It's dry and it's hot. Brazil is in the midst of a heat wave. Oliveira's community, 40 families in the middle of the Amazon, has been badly affected by the drought. They're struggling to access clean water to bathe. Crops are affected too, and getting to and from the city is difficult.
I think that's the end of the line. We've been traveling for nearly 5 hours now, and Oliveira says we're not even halfway, so it looks like we're going to have to turn back. Are you worried about how the weather and the climate here is changing?
Sim. A situação é grande, né? E se der feito se piorar mais do que tá, os caras vão ficar isolados, não tem como ouvir. Aí eu risco aí a cobra, o jacaré que vão ter que atravessar o lago. Aí é mais perigoso do que aqui. Né? Um cara que passa mal lá não conseguiu chegar até a cidade.
Thousands of villages have been cut off by this drought. Over 100,000 people. But scientists are worried that this is an indication of something even more catastrophic, an ecological disaster. And there are signs. In 2 major lakes, dolphins have been turning up dead.
And what happened this year is something that we've never seen before. Nobody's seen before. It's unprecedented. We are used to seeing dolphins frolicking in the lake every day, and we go by them and we see babies and everything. And all of a sudden, one day we woke up and there were 20 carcasses on the shores. And then 5 days later, we had 70 carcasses. It was just devastating.
It was such a shock that the Brazilian government sent an emergency team to try to figure out what was happening. In some places, the water was up to 40.9 degrees Celsius, 3 degrees higher than human and dolphin body temperature.
What do you do? That's where you live, and all of a sudden you're in the middle of the soup, and you can't get away.
You've lived in the Amazon for a long time.
For 30 years.
Have you ever seen anything like this drought?
Never even thought about it.
The fear is that the forest is racing towards a theoretical tipping point. In the vast Amazon, water evaporates from the trees to form rain clouds, and in this way it feeds itself the water it needs to sustain life. If vast swathes of the forest die, it may not be able to do that, and the Amazon would keep dying, and faster, in a catastrophic feedback loop.
This is the heart of the Amazon, and this is what the air is like. Just thick smoke. And smell it.
More signs that the forest is losing the ability to recover. When it's dry, small fires set to clear land for planting burn out of control. The Amazon saw more fires in the past year in its primary or untouched forest.
We have lots of fires. If you can see in the morning, you can hardly see anything here because it's so small, and you can actually feel it, coughing and what. Scientists, they have been saying for years that this was going to happen to the Amazon in 2030, 2050. It's getting worse and worse, and that we were going to be like a savanna, which is the dry areas. But I never expected to see it, and this dramatically. It was just too quick. It happened just like that.
And you didn't think it would happen in your lifetime?
We live in the water. We depend on the water to drink, to bathe, travel, for everything. And the water is much less.
About 17% of the Amazon has been deforested since the 1970s. And if that figure hits 25% and global temperature rises more than 2.5 degrees Celsius, then scientists say the tipping point could be triggered. It would be a disaster for millions of people south of the Amazon who rely on it to produce rainfall. And for the billions of us who rely on the rainforest to help keep the planet cool. The Amazon stores around 150 billion metric tons of carbon.
Do we have rain? Yes, finally. But perhaps not for long. Yeah, not enough. Well, the climatologists are saying this drought will continue.
Flavia Costa researches the health of plants and trees in the forest.
We got to see some plants that are already showing signs of being dead. Some colleagues that are flying drones, they say they can see also canopies that are completely defoliated.
It's too soon to assess what this drought has done to the Amazon, but the last big one in 2015 can give us a clue.
We have seen very large mortality in the last drought when, on average, the Amazon
Amazon started to function as a carbon sink, and we mostly expect the same now, which is sad. Yeah, there might be a moment where the forest starts to lose the capacity to recover, but this is probably not widespread. So some regions will probably become savannas, but there are pockets of forest that probably will remain.
With the rains here now, the forest can recover. But next year, another drought is predicted, and the question is, can it recover enough?
We always say, these animals are sentinels because they feel first what's going to come to us, and that's why I say it's a slap on the face because it's happening to them.
Are you scared? Well, I am, because not only because of the forest, I live here, I understand the drama of the population. Imagine if every 5 years we have a drought, and each drought is a bit worse than the before. Then the forest may really not stand. We might see this tipping point faster than what we were expecting.
E a gente entende que o culpado disso somos nós, que não nos atentamos para isso, não buscamos defender nossa mãe terra. E hoje está gritando por socorro pelos seus filhos, somos nós. A gente sabe que é um pouco tarde, né? A gente
A new global deal on climate change has been approved by almost 200 countries at the UN summit in Dubai. The deal calls on all countries to move away from the use of fossil fuels. This is the first time there's been a clear reference to the future of all fossil fuels in a UN climate summit text. But this deal doesn't include any wording on the phase out of fossil fuels, something many governments wanted. Well, here is the moment the COP president announced the deal.
I invite the CMA to adopt the draft decision entitled Outcome of the First Global Stocktake, contained in document FCC/BA/CMA/2023/L.17. Hearing no objection, it is so decided.
Sultan Ahmed Al Jaber went on to praise the deal as an historic package.
Many said this could not be done. But when I spoke to you at the very start of this COP, I promised a different sort of COP. A COP that brought everyone together. Private and public sectors, civil society, NGOs, faith leaders, youth, and indigenous peoples. Everyone came together from day one. Everyone united. Everyone acted. And everyone delivered. We operationalized loss and damage and started to fill the fund. We mobilized more than $83 billion in new financial instruments. We launched Altera, the world's largest catalytic private investor that is 100% focused on solutions to climate change. And we delivered world's first after world's first. A global goal to triple renewable energy and double energy efficiency, declarations on agriculture, declarations on food, declarations on health. Many more oil and gas companies stepping up for the first time. Stepping up to deliver against very ambitious goals and objectives. And for the first time, to deliver on methane and emissions. And we have language on fossil fuel in our final agreement for the first time ever.
2023年、世界一の投資家、ウォーレン・バフェットが急に投資を控え始めたある分野があることをご存知。
The United States Special Presidential Envoy for Climate John Kerry praised the deal as a success of international cooperation.
I think as you look around this room and you look at the number of people who are here, it underscores the complications, the difficulties, the fundamental challenge of bringing 200 countries together and finding consensus. I think that everybody here should be pleased that in a world of Ukraine and Middle East all the other challenges of a planet that is foundering, this is a moment where multilateralism has actually come together and people have taken individual interests and attempted to define the common good.
Let's go live to Dubai, our correspondent there. Carl Nasman is following all the developments. Carl.
Yeah, that's right. It's been a very rapid pace of developments here in Dubai. We all came early hours of today. We got an updated text, and it felt like after days of waiting, it only took about a few minutes for it to be gabbled through. And we now have a deal. This is the global stock take, which wraps in so many different bits of ambition from the 2 weeks at this COP28. Of course, the biggest headline is that for the first time in decades, these nations gathered together have agreed to transition away from fossil fuels. For the first time, words have been in one of these meetings. Now, we just heard after the gavel went down some impassioned words from low-lying island states, from the alliance of small island states, IOSIS. Here's what they had to say on the radio.
Zoning in on paragraph 26 and 29 of this decision, we have come to the conclusion that the course correction that is needed has not been secured. We have made an incremental advancement over business as usual, when what we really needed is an exponential step change in our actions and support. Mr. President, in paragraph 26, we do not see any commitment or even an invitation from parties to peak emissions by 2025. We reference the science throughout the text and even in this paragraph, but then we refrain from an agreement to take the relevant action in order to act in line with what the science says we have to do.
So despite the historic nature, of course, of this agreement, not every country is completely satisfied. There are many developing nations and many nations like Samoa that are on the front lines of climate change that feel like this deal simply doesn't go far enough. I'm joined by a couple of guests here. I have Rihanna Fruin, who is from Samoa, a Pacific Climate Warrior, and also Drew Slater, Pacific Climate Warrior from Fiji. Rihanna, I'd love to start with you. You heard the representative there from Samoa, speaking on behalf of the IOSIS Alliance to small island states. What did you make of that speech and the message behind it? Is there satisfaction among people from Samoa or similar nations that are on the front lines of climate change? Are they satisfied with this deal?
Simply no. I think I echo the words of our AOSIS chair, Annie, that there was so much that we needed to say, but weren't even given the time because some of the AOSIS members weren't even in the room when it was gabbled. And she said in her statement that she was a little bit confused as to what was happening. And then if you want to go and look at what in the text AOSIS opposes to, you can have a look at her statement.
Drew, how about you? Are those similar sentiments on your part? You're from Fiji. Is there concern that nations such as Samoa, such as Fiji, simply were left out of the process right at the end of this deal?
I think it was gavelled very rapidly, and as AOSIS chair said, some of the AOSIS representatives weren't in the room, and there was a bit of confusion. And there are also clear points of concern in the text, particularly around the lack of phase-out. Acknowledging the transition away from fossil fuels is historic, yes, but it's a signal. We've heard it's a signal, and the time for signalling is long past.
Well, is there enough in this deal that you think this could make a difference, potentially keep the world on track to meet our 1.5 degrees Celsius goal?
There's incremental change. So there's small bits in there of success, but it's not what we need it to be. It's not what we need it to be to get out of this trajectory that we're on. And we made it clear 1.5 is a red line for us. We can't cross 1.5 because our survival is on that line. And there's text in there that crosses that 1.5 line.
True, there were concerns, of course, coming into this COP28 that was being hosted in an oil nation, that the COP28 president is also the CEO of an oil company. In the end, do you think that those concerns affected the outcome here?
I think we need to acknowledge that there were over 2,000 fossil fuel lobbyists present at COP28, a significant increase from the COP before. I think it's also important to acknowledge that the outcome possesses some loopholes that could benefit the fossil fuel industry, referring to abatement, referring to transition fuels like gas. So it does feel like this could have been a win because it doesn't completely phase out fossil fuels. There's still room for expansion.
Rihanna, I think there are some that might say this seemed to be an impossible deal to get oil nations on board with something. We saw the leaked document from OPEC saying that they would absolutely oppose any language to a fossil fuel phase-out, and yet to get fairly strong language on fossil fuels. Does that seem like a win, given those circumstances?
I mean, I've said this before today. It's like asking us to celebrate flowers that will lie on our grave. How can you ask us to do that? And at the same time, I think it's about transparency. The thing is, we were asked to come to this COP, and at the very beginning, we got word from the presidency that this would be a historic win. There was no real history made. This, yes, a small historic win of having fossil fuels in the text, but it's almost like the spirit of how we began this COP is not how we're ending it.
Rihanna Fruin from Samoa, Drew Slater from Fiji, both Pacific Climate Warriors. Thank you to you both for coming to share your perspectives on this text, which has just been approved in Dubai. One note just to end on, we heard, of course, that big standing ovation after Sultan Al Jaber gavelled through this agreement. There was another standing ovation after that speech from Samoa on behalf of these smaller states, and that lasted longer than that initial round of applause. That could just show you that there are plenty of concerns still about whether or not this deal goes far enough.
Okay, Carl, thanks very much. Let's take you back live to the COP summit, where we can hear now from the UK Minister for Climate, Graham Stewart, who is speaking.
And on finance. We're fully committed to doubling adaptation finance, and we recognise that this is just the floor. We need to finance the energy transition. This all needs to be part of our conversation next year as we step up deliberations on the new collective quantified goal. Mr. President, we are facing an unprecedented challenge with the climate crisis. And although there is a long way to go, and we need to move much faster, this outcome is something we can genuinely celebrate. Thank you.
UK Minister for Climate, Graham Stewart, there welcoming this deal that has been agreed by 200 countries at the COP summit in Dubai.
ホットペッパービューティー、名前はみんな知ってるのに、学割の代償クーポンで2500円になるんですよね。
Now, in South India, over 7,000 people have been evacuated ahead of a severe cyclonic causing torrential in Michoacán, expected to make landfall in the next 24 hours. BBC reporter Pramila Krishnan has more on this.
Cyclone Nijan has affected Chennai city today. India Meteorological has predicted extreme heavy rainfall today and moderate rains will continue for 3 more days. In 2014, Chennai city suffered very badly in floods. So the residents in the city are worried and gripped in fear. Several hundred lives were lost in floods in 2015. So many residents are locked up in their houses and high-rise apartments. Many people in the low-lying area were rescued and put up in the relief camp centers. Over 200 relief centers have been set up in the city. Train services have been suspended and the flights are diverted to the nearby states. This cyclone Nijan is expected to cross Andhra Pradesh coast tomorrow with wind speed of 80 to 100 km per hour.
We'll have more on this with Ambarasan Etharaj, South Asia regional editor for the BBC World Service. Ambarasan, welcome to you. Bring us up to date on the cyclone, what impact it's having and how people are being evacuated.
As we speak, the southern Indian city of Chennai is impacted with heavy rains and floodwaters. And the officials were saying that more than 30 centimeters of rain in the past few days. And the cyclone, which is likely to develop into a super cyclonic storm, is expected to cross the southeastern coast sometime tomorrow morning. So this Chennai, which is one of the big metropolitan cities of India with a population of more than 7 million, has been impacted and floodwaters have entered residential areas. There have been pictures of cars being swept away in these floodwaters, and the city also hosts 2 rivers which passes through the main areas of the city. They are overflowing. As a result, the rainwater has not been able to go and meet the river, and many residential areas are now underwater. Now, the authorities have announced many relief centers. People can go there. Many schools have been converted into temporary residential centers. And Chennai is also an industrial hub with many automobile companies and a company which makes iPhone. It is also on the outskirts of the city. They have been operating partially, and the authorities are warning people not to come out, not to travel until it is very essential. And the airport services have been shut down. Train services have been severely hampered. And now they are hoping that there won't be any more strong rain. But then people are worried that when the cyclone crosses, there could be more inundation. And what happened in 2015, as the reporter was mentioning, that many residential areas were flooded.
Yeah, I was going to ask you how common this kind of weather event is.
Monsoon is not very unusual in the southern part of India. This is the monsoon season, but cyclonic storms also occasionally hit the coast. But what's happening in these developmental activities over the decades, because the floodplains and the water catchment areas have now become residential apartment complexes, and this is one of the most industrialized areas of India. So you see the huge growth of IT industry and the automobile industry. So as a result, all these blocks, residential tower blocks, have come up blocking these floodwaters going and meeting the Bay of Bengal. So that is one of the reasons why environmental activists have been saying for years that lessons should have been learned from 2015, that all these encroachments, and they should not give planning permission to these new blocks in the floodplains, or also this whole area is surrounded by lakes, more than 50 lakes around the city of Chennai alone. So when the lakes are full, then they come into the rivers and then into residential areas. So people are worried.
Okay, Ambarasan, thank you very much for updating us there on that cyclone in South India.
harrowing machines are getting ever more powerful. Nowhere is that more on show than at this test centre in northern Denmark.
It is the latest and biggest turbines that have been prototypes. This is like seeing the testing the future right here.
The largest, a staggering 280 metres high, has broken world records for the most power. And experts say they're only getting bigger.
This race towards bigger and bigger turbine will continue for a while more. We are looking into the possibility of creating a new test center in Denmark, and the design turbine we are designing for is 450 meters from ground to high speed.
By 2030, wind power could supply a fifth of the world's electricity. We need green energy, but this green industry has a growing headache when it comes to waste.
Turbines are built to withstand the forces of nature. They're flexible, light, and super strong. But that's also where the problem lies. When they reach the end of life, they're really hard to recycle.
While the steel in the towers can be reused, the massive blades are almost indestructible. And as older models are replaced, many get dumped in landfill. By 2050, there could be 43 million tons of redundant blades globally that need to be dealt with.
It is problematic because we want the renewable energy to be truly sustainable. And if you have a waste material that goes to landfill, it's not truly sustainable.
It's a problem players have been scrambling to figure out. And we might now have some answers.
There have been creative ways of reusing wind turbine blades, like this bike shed.
They've even been repurposed for playgrounds, bridges, and building cladding. But this won't really tackle the growing volumes. One immediate solution is to chop up and finally shred them. It's burned as fuel and used as an ingredient to cement production. This US plant has already handled more than 3,500 unwanted blades. Now, turbine maker Siemens Gamesa has had a breakthrough at its own. It manufactures some of the world's biggest blades at its site here in Aalborg. And while this one looks like any other, it can be recycled. It all comes down to a resin called epoxy, which acts like a really strong superglue binding together the fiberglass. Usually, this is incredibly tough to break down, but not here.
When you change something in the backbone of the chemistry, this base has actually gone through our recycling process and just turn it around. Here, you can see all the different glass layers that were placed through the production of the blade and how they are separating from the blade.
To do that, it needs to be soaked in a big bath of mild acetic acid.
After a few hours and 80 degrees Celsius, and then you get the result that you see here.
So it's just like vinegar in a supermarket.
Exactly like we would make pickles or descale the coffee pot.
I can actually smell that. There is a scent of vinegar coming from the blade.
This won't tackle today's waste, but when these blades retire, the materials could go into making other things.
It could be furniture, suitcases. You could use it for surfboard manufacturing, etc.
Yep.
So in general, consumer goods.
But not new turbines.
Not as it is right now. But I'm never going to say never.
So far, only a small number have been installed, but they'll soon be used for bigger offshore projects here in Europe. At this research lab at Orange University, scientists are taking a different approach.
This was part of a wind turbine that was decommissioned. Basically put the chip in there, and then we had a catalyst.
They've discovered a chemical process that gently breaks apart the components. Precise details are still under wraps, but it turns out it's relatively simple.
These are the glass fibers, so they kind of come apart a little bit
Yes, I can see those.
because they're not bound together anymore.
So you can see it's very clearly separated into different components.
That means the fibers and even that tough epoxy resin could be recovered and potentially reused.
This has been quite remarkable. We thought that these materials were extremely strong and indestructible. Now we found a chemical process that can actually chew its way right through the epoxy.
And in theory, it could work on all kinds of turbine blades already out there.
What we find exciting is sort of the first to be able to do that. There are potential to recycle such very tough materials, not only confined to the wind turbine, it's the aeronautic industry, space industry, cars.
This technology still needs to make the leap from a test tube to the real world. But with new solutions on the table, perhaps this growing waste problem could be headed off before it gets too big. Is taking
supposed to be the hardest bit, but we'll see.
The Amazon rainforest has been through its worst drought on record. Its rivers, lakes, and streams drying up.
So we should be able to pass through here. Normally, even in the dry season, but we're getting to.
Nunca tinha tido essa seca, né, com essa proporção. Eu nunca tinha visto. Nem história. Seca, mas não no nível que está agora.
It's dry and it's hot. Brazil is in the midst of a heat wave. Oliveira's community, 40 families in the middle of the Amazon, has been badly affected by the drought. They're struggling to access clean water to bathe. Crops are affected too, and getting to and from the city is difficult.
I think that's the end of the line. We've been traveling for nearly 5 hours now, and Oliveira says we're not even halfway, so it looks like we're going to have to turn back. Are you worried about how the weather and the climate here is changing?
Sim, a preocupação é grande, né? Que se de repente se piorar mais do que está, os caras vão ficar isolados, não tem como. Aí é o risco aí, a cobra, o jacaré que você atravessar o lago. Aí é mais perigoso do que aqui. O cara que somar o lago e conseguir chegar até a cidade.
Thousands of villages have been cut off by this drought. Over 100,000 people. But scientists are worried that this is an indication of something even more catastrophic, an ecological disaster. And there are signs. In 2 major lakes, dolphins have been turning up dead.
And what happened this year is something that we've never seen before. It's unprecedented. We are used to seeing dolphins frolicking in the lake every day, and we go by them and we see babies and everything. And all of a sudden, one day we woke up and there were 20 carcasses along the shores. And then 5 days later, we had 70 carcasses. It was just devastating.
It was such a shock that the Brazilian government sent an emergency team to try to figure out what was happening. In some places, the water was up to 40.9 degrees Celsius, 3 degrees higher than human and dolphin body temperature.
You live, and all of a sudden you're in the middle of the soup.
You lived in the Amazon for a long time?
For 30 years.
Have you ever seen anything like this drought?
Never even thought about it.
The fear is that the forest is racing towards a theoretical tipping point. In the vast Amazon, water evaporates from the trees to form rain clouds, and in this way it feeds itself the water it needs to sustain life. If vast swathes of the forest die, it may not be able to do that, and the Amazon would keep dying, and faster, in a catastrophic feedback loop.
This is the heart of the Amazon, and this is what the air is like. Just think of smoke. Smell it.
More signs that the forest is losing the ability to recover. When it's dry, small fires set to clear land for planting burn out of control. The Amazon saw more fires in the past year in its primary or untouched forest.
We have lots of fires. If you can see in the morning, you can hardly see anything here because it's so smudgy and you can actually feel it coughing a lot. The scientists, they have been saying for years that this was going to happen to the Amazon in 2030, 2050. It was getting worse and worse, and that we were going to be like a savanna, which is the dry areas. But I never expected to see it in this dramatically. It was just too quick. It happened just like that. And
you didn't think it would happen in your lifetime?
So, we live in the water. We live in the water to drink, to bathe, to travel, for everything. And in the water is much less.
About 17% of the Amazon has been deforested since the 1970s. And if that figure hits 25% and global temperature rises more than 2.5 degrees Celsius, then scientists say the tipping point could be triggered. It would be a disaster for millions of people south of the Amazon who rely on it to produce rainfall, and for the billions of us who rely on the forest to help keep the planet cool.
The Amazon stores around 150 billion metric tons of carbon.
Yeah, right. Well, the climatologists are saying this drought will continue.
Researches the health of plants and trees in the forest.
We got to see some plants that are already showing signs of being dead. Some colleagues that are flying drones, they say they can see also canopies that are completely defoliated.
It's too soon to do the Amazon, but the last big one in 2015 can give us a clue.
We have seen very large mortality in the last drought when, on average, the Amazon stopped to function as a carbon sink, and we mostly expect the same now, which is sad. Yeah, there might be a moment where the forest starts to lose the capacity to recover, but this is probably not widespread. So some regions will probably become savannas, but there are pockets of forest that probably will remain.
But the rain's here now. The forest can recover. But next year, another drought is predicted, and the question is, can it recover enough?
We always say, these animals are sentinels because they feel first what's going to come to us, and that's why I say it's a slap on the face because it's happening to them, it's going to happen to us.
Are you scared? Well, I am, because not only because of the forest, I live here, I understand the drama of the population. Imagine if every 5 years we have a drought, and each drought is a bit worse than the before. Then the forest may really not stand, and we might see this tipping point faster than what we were expecting.
Muitos culpados disso somos nós, que não nos atentamos para isso, não buscamos defender nossa mãe terra. E hoje está gritando por socorro pelos seus filhos, somos nós. A gente sabe que é um pouco tarde, né? A gente
A new global deal on climate change has been approved by almost 200 countries at the UN summit in Dubai. The deal called on all countries to move away from the use of fossil fuels. This is the first time that clear reference to the future of all fossil fuels in a UN climate summit text. But this deal doesn't include any wording on the phase out of fossil fuels, something many countries wanted. Well, here is the moment the COP president announced the deal.
I invite the CMA to adopt the draft decision entitled Outcome of the First One-Stop contained in document FCCA/BA/CMA/2023/L.17. Hearing no objection, it is so decided.
Sultan Ahmed Al-Jaber went on to praise the deal as an historic package.
Many said this could not be done. When I spoke to you at the very start of this COP, I promised a different sort of COP. A COP that brought everyone together. Private and public sector, civil society, NGOs, faith leaders, youth, and indigenous peoples. Everyone came together from day one. Everyone united. Everyone acted. And everyone delivered. We operationalized loss and damage and started to fill the fund. We mobilized more than $83 billion in new financial commitments. We launched Altera, the world's largest catalytic private investor that is 100% focused on solutions to climate change. And we delivered world first after world first. A global goal to triple renewable energy and double energy efficiency. Declarations on agriculture. Declarations on food. Declarations on health. Many more oil and gas companies stepping up for the first time. Stepping up to deliver against very ambitious goals and objectives. And for the first time, to deliver on methane and emissions we have language on fossil fuel in our final agreement for the first time ever.
The United States Special Presidential Envoy for Climate John Kerry praised the deal as a success of international cooperation.
I think as you look around this room and you look at the number of people who are here, it underscores the complications, the difficulties, the fundamental challenge of bringing 200 countries together and finding consensus. I think that everybody here should be pleased that in a world of Ukraine and the Middle East war and all the other challenges of a planet that is foundering, this is a moment where multilateralism has actually come together and people have taken individual interests and attempted to define the common good.
Let's go live to Dubai. Our correspondent there, Carl Nazan, is following all the developments. Carl.
Yeah, that's right. It's been a very rapid pace of developments here in Dubai. We all came in the early hours of today. We got an updated text, and it felt like after days of waiting, it only took about a few minutes for it to be gabbled through and passed. We now have a deal. This is the global stock take, which wraps in so many different bits of ambition from the 2 weeks at this COP28. Of course, the biggest headline is that for the first time in decades, these nations gathered together have agreed to transition away from fossil fuels for the first time. And those words have been in one of these agreements. Now, we just heard, after the gavel went down, some impassioned words from low-lying island states from the Alliance of Small Island States, AOSIS. Here's what they had to say just moments ago.
Zoning in on paragraph 26 and 29 of this decision, we have come to the conclusion that the course correction that is needed has not been secured. We have made an incremental advancement over business as usual, when what we really needed is an exponential step change in our actions and support. Mr. President, in paragraph 26, we do not see any commitment or even an invitation from parties to peak emissions by 2025. We reference the science throughout the text and even in this paragraph, but then we refrain from an agreement to take the relevant action in order to act in line with what the science says we have to do.
So despite the historic nature, of course, of this agreement, not every country is completely satisfied. There are many developing nations and many nations like Samoa that are on the front lines of climate change that feel like this deal simply doesn't go far enough. I'm joined by a couple of guests here. I have Brianna Fruin, who is from Samoa, a Pacific climate warrior.
For the first time in more than 100 years, Ukraine will mark Christmas today instead of in January. It's a way of the country cutting ties with Russia, which celebrates the Holy Orthodox calendar. Well, let's show you these live pictures from St. Michael's Cathedral in Kyiv. As we were saying, for the first time, believers of different religious denominations will be celebrating Christmas on the same day. As you can see there, it's just one of the number of services being held on this day across Ukraine. As Ukrainians mark a second Christmas at war, President Zelensky said he's praying for victory and for evil to be defeated. His holiday address came after American politicians were unable to agree on military aid worth almost £50 billion for Kyiv. Here's our Ukraine correspondent, James Waterhouse, who's reporting from the city of Kupiansk near the eastern border, which was occupied for 6 months after Russia's full-scale invasion and comes under almost daily attack.
Christmas in Kupiansk is a celebration in name. Children were evacuated from this frontline city, and only 5,000 people remain. It used to be 5 times that. Days are punctuated with artillery shells and sirens. Life continues for those who've stayed, but it's a tense existence.
We all live in fear of death. When we go to work, we don't know what will happen, whether Russia will strike with rockets. We all live on the edge. We don't know whether we'll come back home alive.
17-year-old Sophia has lived through both occupation and liberation. Her dad is fighting, and she's not impressed with her country being determined against Western politicians.
Perhaps they should come here and see for themselves what the situation is like and how much the aid is needed. If there's no help for Ukraine now, Russia will take its aggression further.
The Russians are 8 kilometers to the east of the city, but what Ukraine's military is worried about is them pushing once more up to the Oskil River before making another push. And that is the point Kyiv is trying to make. If Western support was to further slow down, the And Russia won't stop there. It still wants the whole of Ukraine. The briefest of pauses for a Christmas prayer. Large gatherings are dangerous here when Russian drones loiter above. Instead of these troops forcing out their invaders, it is them repelling constant attacks.
It's day and night. There are no breaks. It's 24/7. So you have more targets, so you need more shells. They throw lots of men and machinery into battle. They don't pity anything.
It's hard to sell a victory which seems distant. Ukraine's struggle to contain Western doubt has left it with a new year looking far from certain. James Waterhouse, BBC News,
Well, the Ukrainian capital, Kyiv, isn't very far from the front line where the country's soldiers are fighting Russian troops. So how does it feel to celebrate Christmas under the constant shadow of war? Well, James, who you saw just there, sent us his impressions.
It is the first time in more than 100 years that Ukraine celebrates Christmas on the 25th of December, but it's a very difficult time. We're not seeing much in the way of festivities in this part of Ukraine. Large gatherings are a rare occurrence. This is somewhere that comes under frequent assault from the sky. It's 40 miles from the Russian border, but President Zelensky was keen to strike an optimistic, a hopeful tone in his Christmas address, where he said he would pray for a Ukrainian victory and, in his words, for evil to be defeated. He talked of previous struggles Ukraine has gone through, whether it was under the Soviet Union or through Nazi Germany, and he's drawing direct parallels. But I think these are incredibly difficult times. 12 months ago, his military had liberated swathes of territory throughout the autumn. There was a belief that Ukraine wouldn't stop there and a belief that Ukraine could still win this war. I think that belief is enduring, but there is a pragmatism starting to creep into, because the last 12 months has seen Ukraine's counter-offensive, but it's also seen Russia not only hold on to the fifth of Ukraine that it has taken and occupied, but it's also shown Russia can defend it too. And this is a war which favours fewer men. It has fewer resources than Russia. Russia is now starting to make its size count. We are in a war of attrition. We've seen dozens of drones shot down again overnight. That's now part of a regular routine in Ukraine. And we are seeing Ukraine repelling wave after wave of Russian attack in some parts of the front line. We're even seeing it scale down its military operations in others, because the waning Western support isn't just putting Ukraine's future military hopes into jeopardy, it's affecting them right now. And we've heard Western governments say, we're in it for as long as it takes for Ukraine. We can't allow Russia to win, but there's a political reality setting in, whether it's opposition MPs, whether it's a new government that doesn't want to provide new support for Ukraine. And the argument here is that is what Russia has been waiting for. Any kind of peace deal or negotiation suits Vladimir Putin, because it lessens that urgency on Western support to continue, and it allows Russia to continue being on a war footing, so it can make a push, Ukraine argues, in the coming months or even years for Kyiv once more.
アインシュタインに世界一の天才と称された男が皇居を守ったわけ。原爆投下の3ヶ月前、原子爆弾を作った科学者フォン・ノイマンはアメリカ。
At least 70 people have been killed by an airstrike in the Al-Maghazi refugee camp in Gaza, according to the Hamas Health Ministry. Body bags have been piling outside the Al-Aqsa hospital where many of the victims were taken. Israel says it's investigating the incident. It comes amid scaled-back Christmas celebrations in Bethlehem and across the occupied West Bank. Let's take a look at some live pictures this morning. We're showing you now the scene in southern Israel, on the border with Israel, looking out to Gaza. Our correspondent Joe Winwood has been monitoring the latest developments.
For the people of Gaza, there is no respite. This was once a residential block, reduced to rubble. Multiple generations of families are said to have been killed, seemingly caught unawares.
We were having dinner when suddenly the bombing started without any warning. In an instant, our house collapsed.
The victims were taken to the nearby Al-Aqsa hospital. In a population as young as this, children are so often the victims. This incident already has one of the highest single death tolls since this war began, and it is expected to rise. The Hamas-run health authorities say more than 20,000 people have now been killed in Gaza since Israel launched its offensive. Israel maintains it tries to avoid civilian casualties and blames Hamas for hiding amongst the population. The IDF released new footage showing what it says are tunnels under the strip used for military purposes.
Hamas operates from civilian areas. It uses them to cover its terrorist activity. It is a very complex challenge that we face, and we do it well, so our forces in the field achieve good results, like the brigade that found the tunnel network.
While the vast majority of destruction has been in Gaza, the West Bank has not been spared. In the place where Christianity was born, they marked the birth of Christ by remembering the deaths this conflict has brought.
We used here to have the lighting of the tree, Christmas tree in the middle here. And we used to have a big Christmas market in the playground now, in the school. And we used to celebrate every night, at least for a week before. But this year, we are just praying by night, the Holy Mass, and we will pray for peace.
But those prayers are yet to be answered. This has been the most devastating conflict between Israelis and Palestinians in modern times, and it shows no signs of ending. Joe Inwood, BBC News.
Now let's go live to Cairo, Egypt, where we can speak to Saddam Sayaleh. He's the regional development lead at ANERA, that's the American Near East Refugee Aid NGO. Now I understand that Saddam, you have been coordinating some of the aid that is going through to Gaza from the Rafah crossing. Tell me about the situation when it comes to aid at the moment.
Thank you for hosting me today, and Merry Christmas to everyone. I've been deployed as an ANERA. I'm based in Jordan. I've been deployed to Egypt since the beginning of the war, trying to coordinate the entry of aid through Egypt to Gaza. So far, ANERA been a little bit successful in allowing some of the aid to get into Gaza. That we're focusing on food. So far, ANERA been able to distribute over 8 million food parcels, vegetables, baskets, doing shelters cleaning. We were able to do over 1 million medical treatment for the health facilities inside Gaza, with 5 pop-up health clinics and winterization inside Gaza. As you know, we're looking inside Gaza. The situation is very dire. We're looking at 9 out of 10 people who are eating less than 1 meal a day. And this is a testament, by the World Food Program and the Integrated Food Security classification that was activated just recently, that is bringing the alarm that we're looking into a famine in Gaza. We're looking at 85% of Gaza that is being displaced. We're looking at 1.9 million people out of their homes.
And Saddam, how much relief has this UN resolution, the Security Council spoke last week, made, if anything, in terms of the difference to the aid that's getting through?
Unfortunately, since the very beginning of the war, and this is a reality, humanitarian aid is not enough. The amount of trucks that are going inside Gaza are not enough. On normal day, before the war, we were looking at minimum 500 trucks going inside Gaza. Today, we're looking at less than 100 trucks going inside Gaza, and we're looking into a catastrophe because the displacement, the need is massive. The children are reported who have dehydration, they're not eating. The World Food Program are saying 9 out of 10 people are eating less than 1 meal a day. So that is a testament that the aid that is going in is not enough, and we need more of that, and we need more humanitarian aid to be allowed in. There are many organizations like ANERA who have great responses at the very beginning of the war because of the humanitarian situation inside Gaza that we need to support and push for more humanitarian aid to get inside Gaza.
And Saddam, is there anything more your contacts on the ground can tell us about this airstrike today at the Al-Maghazi refugee camp? We're hearing that at least 70 people have been killed there.
Absolutely. Like, we have a team, we've been operating in Gaza for over 45 years. Our team are from Gaza. The humanitarian workers are at a critical position, because of the communication blackout, the bombardment that is happening in a very chaotic way. We're hearing every day from our team about the risk of distributing aid, but as well about the bombardment that is happening all over Gaza, that is challenging the humanitarian distribution inside Gaza, that is creating barriers. Even if you have aid, it's still very difficult to get that aid to where it's needed. So we need a ceasefire. We need more humanitarian aid getting into Gaza to support children, women, the people who are the 85% of people who are displaced inside Gaza.
Okay, Saddam Sayaleh from ANERA, thank you very much for bringing us up to date on the work that your organisation does and on the situation in Gaza.
Thank you.
Well, we can now cross line to Bethlehem and join our correspondent there, Shaima Khalil. Shaima, a much more subdued Christmas this year.
Virginie, Bethlehem feels and looks very, very different. Christmas is supposed to be the height of the season of celebrations here in Bethlehem. The eyes of the world would have been on this place, the birthplace of Jesus, for celebrations, leading the world into the marking of Christmas, and yet it looks nothing like its festive self. I've been here for days, and I've been at Manger Square, where the huge Christmas tree is supposed to be, where it would be heaving with activity, with pilgrims and tourists celebrating Christmas. None of that is happening. Instead, yesterday, in the place where the tree was supposed to be, many dozens of Palestinian children held a Palestinian flag, and waved it with a message of solidarity for Gaza's children. The scouts were holding banners saying, "We pray for Gaza. Gaza is in the heart." And you do feel that these images that come out of Gaza, including, of course, from Al-Maghazi, where what you saw in Joe's report and what you've been reporting, they hit very close to home here, because many here also have family and friends trapped inside Gaza. I spoke to one young man who's on the phone to his father, and his father is trapped in a church in the east of Gaza City. And his dad was telling me there's just destruction all around us, and they're very reluctant to move, because he says that the roads leading to areas in the south are extremely dangerous, but also he said that many people who have moved to supposedly safer areas have been killed. And that's the complaint that you hear, even from people that made it out of the Rabin and Malazi. They've been evacuated from Gaza City to come to central Gaza, only to be hit like they had last night.
John, I wanted to ask you as well about reports that we're hearing that Egypt has now put forward a new proposal for a ceasefire. We've been hearing in the last week or so that talks have resumed, and that we haven't really heard much more. What more can you tell us about these latest reports, Shima?
Yeah, this is another proposal from the Egyptians. Remember when Ismail Haniyeh was in Cairo last week, there was a bit of hope that the negotiations could be underway. Serious negotiations would be underway. They've hit a setback when Hamas came out and said there will be no deal to exchange hostages without a ceasefire, which is out of the question for the Israeli government. This is a three-phase proposal, which could see weeks of separate weeks of humanitarian pauses, but crucially negotiations on the initial on releasing the all civilian hostages in the first phase, then female soldiers in the second phase, and then all the hostages ultimately in exchange for several Palestinian prisoners in Israeli jails. And crucially, the hope is for a push for these humanitarian pauses. We've heard reports from the Israeli media of officials saying the war cabinet is going to meet later today to discuss this. An official was saying, look, this is a first draft. There are going to be many other drafts until a decision is made. And we've heard that several times, remember, Regini, with the UN resolution as well. But potentially this could lead to some serious negotiations. But I think what doesn't change is the stance of both sides. Remember, Israel has suffered one of its biggest losses, soldier losses, in the last 48 hours. And Benjamin Netanyahu has had to acknowledge this, but said the war is not going to stop. This is going to be a long war. Hamas keeps firing rockets in Israel. This week, sirens were sounding near Tel Aviv. And unless those two stances budge, humanitarian aid and that ceasefire is not going to be possible. And I think this is where the big challenge for Egypt and other negotiators is going to be.
Difficult Christmas this year for so many. Shima Khalil reporting for us from Bethlehem.
ってどれ？え？インターネットで探そう。二人でゆっくりご褒美時間だね。
Should we automate away all the jobs, including the fulfilling ones? Should we allow AI machines to flood the internet with propaganda and fake news? Should we develop non-human minds smarter than our own, machines that might one day outnumber us or outsmart us? Do we risk losing control? Now, you might think that sounds like some futuristic script from a Terminator movie, but last month, some of the most well-known figures who are involved in the development and training of artificial intelligence called for a moratorium until we better understand where we're going. An open letter was signed by thousands of entrepreneurs, academics, and scientists, including Elon Musk, who wants the training of intelligence halted for at least 6 months. We're going to dig deep into this over the next 20 minutes or so in the company of two people who know a thing or two about it. Joining me is the tech investor, Evan Burfield, the author of Regulatory Hacking, a playbook for startups. He's in Texas. And Professor Gary Marcus is in Vancouver. He's the Professor Emeritus at New York University and author of Rebooting AI. Professor, let me start with you. Clearly, with such advances that we're seeing, we have to set some guardrails. Who do you think should be in charge of that?
We both professors. I think that we need global governance for AI. I think that we have a lot of patchworks right now, almost balkanized. Worst case from the company's perspective and the world's perspective is if there's 193 jurisdictions, each deciding their own rules, requiring their own training of these models, each run by governments that don't have much specific expertise in AI. So what I call for an economist editorial earlier this week in the TED talk earlier this week is to have a global system modeled on something like the International Atomic Energy Authority, where the world comes together and says, we have a new threat here, but it's really a new set of threats and we need to work together on that. So number one thing is it should be global, and number two thing is it can't be just policy, but it also has to be a research side, because we need to invent new tools like we had to invent for fighting spam and cyber warfare and so forth. There's so many different threats, as you mentioned, around misinformation, cybercrime, and so forth. So we need to have a kind of standing organization that's global and well-financed to try to build tools to mitigate those threats.
So, Evan Burfield, there are many people who just want to press the pause button until we work out some of these things. But I can already see, and I've heard, the reasons why that probably isn't possible. And that is because not everybody will stop. And people are worried about losing competitive advantage. So how do we best go about this?
Yeah, I think that's exactly right. The challenge with a moratorium is that it's incredibly hard to enforce. The responsible actors would be more likely to follow it. The irresponsible actors wouldn't. But that's actually not so much my concern with the moratorium. There's absolutely questions we need to be asking about the governance of AI, about what industry can do, what government can do. I think the letter did spark a conversation. Schumer is working on a new AI bill here in the U.S. Rumors McCarthy's working on a Republican version. But what I think is actually much more important is to start to have the conversations about how we prepare our society, our economy, our political system, democracy itself, for all of the implications of AI that are coming one way or another. And I suspect we'll see a year from now, we'll go, this was less impactful than we thought. 5 years from now, it will be an absolute tsunami of upheaval. And we have this window right now where we can have this conversation and we can get creative, and I think we've got to use it. And a moratorium gives us this false sense of security that we have control and can stop it, versus figuring out how we ride this tsunami and try to direct it in a much better direction.
Professor Marcus, did we learn anything from the last technological advance, the advance of the internet, of social media? Are there lessons from that, which let's face it, we didn't do very well, that are applicable here?
I think the number one lesson is you don't want to close the barn door after the horse has left. I think we're very late in figuring out what to do about social media. I think we probably handled privacy in the wrong way. We wound up with so much polarization and hostility. We wound up with misinformation. I think we waited too long to act. I think the number one lesson is we should get on it right now. And I agree with the other panelists that the moratorium, you could argue about the merits, whether it was the right thing or the wrong thing. It was absolutely the right thing to raise this and get it on everybody's agenda. This is not something we want 6 months from now. It's something we need now.
So, Evan Burfield, when you talk about a tsunami in 5 years' time, what does that look like?
Look, I'm down here in Austin, Texas, at Capital Factory Startup Accelerator. I've spent the whole day meeting with startups, and there's not a startup right now out there that is not applying these AI generative models, these large language models, to every interesting problem under the sun. And there's all of the scary dystopian possibilities that you led into this segment with. But there's also incredible advances in how to make work more fulfilling and more impactful, how to apply tremendous personalization to medicine based on our genetics, our environment, the particular issues we're having. How do you make government more responsive and feel more like a concierge to citizens? All of that is also being worked on. And I think figuring out how we put the guardrails in place around some of the scarier things, which isn't just about regulating AI, it's about changing our social policy, changing our market policies themselves, so that we can mitigate some of that and direct this into the much more hopeful and optimistic directions.
Why on that point though, is it imaginable in the current scenario, you are around it all the time, that a research lab would cross a critical line here without even noticing?
I'm personally skeptic. Gary's written some wonderful points about the fact that we're very, very far, I believe, from artificial general intelligence and the Terminator scenarios. I think what we've got to be very aware of right now is simply that this technology is already right now today at a state, if it did not advance any further, where its application is going to profoundly change how we live our lives, how we work, how we engage with each other in communities, how our democracies function. The impacts on our democracies are going to be felt right in the 2024 political cycle here in the U.S. That's what I think we need to be talking about and preparing for. The scenarios of AI is like nuclear weapons, we have to ban it immediately, I think are much less applicable to the much more realistic changes that are already happening around us right now that are going to accelerate.
Miles, you've just come back from Washington, and I know that you've been talking to policymakers about the specific issues. In fact, the reason we're talking about it tonight is because you tweeted, "No one has a clue." I mean, is it as blunt as that nobody really understands it? There is practically no work being done on it?
Christian, you're spot on. The three biggest challenges right now with policymakers are, one, this was completely foreseeable. There were some of us in Washington talking about this 10 or 15 years ago. Policymakers weren't paying attention, and most of the think tanks in Washington really failed to start a conversation about the practical things that needed to be done to prepare for the age of AI. So we're behind the ball from a policymaking standpoint. The second thing, I would emphasize what Evan Burfield just said. There is a wave coming, and you can do two things when a wave is coming. You can get crushed by it, or you can ride the wave. And to use another analogy, right now the discussion in Washington is about whether to put the genie back in the bottle or not. That shouldn't be the discussion. It should be, what three wishes should we ask the genie? And that's the discussion that should be had about how to handle AI and use it for good purposes. And finally, the other problem is policymakers are not thinking two steps forward on the chessboard. It's AI right now, but in this decade, AI is going to be supercharged by other technologies like quantum computing that are going to give machines genuine human-like emotion. What are we doing to prepare for that? We should be having that conversation now. There needs to be institutions in Washington that focus on that.
So, Jack, we've had a discussion about that in this country. The UK government has decided that it doesn't need a dedicated UK regulator for AI. So who's overseeing it?
That's a very good question. I mean, I was on stage last night with the Chancellor, Jeremy Hunt, and I asked him about this. He's the guy in charge of the UK economy. And he was really quite dismissive in the sense that he said, this is something that's going to happen, and we have always embraced new technologies in this country, and we should do so. Again, it's full steam ahead was the phrase that he used. He was very, very positive. He did not want to talk about the possibility that people would lose their jobs because of this technology. He only saw it as a purely positive thing, and he was not keen to talk about the way it should be regulated. Now, I'm no expert on this stuff. I'm a politics guy, but what I do know is how Westminster works and how political systems work. And I can tell you now, and you'll know this, Christian, there is no way our political system is set up to deal with this challenge. Absolutely no chance. The speed at which decisions are made in Westminster, and I suspect in other major political centres, is far too slow to cope with the pace at which this technology is coming. The policymakers do not understand it at all. This is just something that is going to wash over us, and we're going to have to cross our fingers. The UK government put out a white paper, which is what they call their draft strategy on AI the other day. I mean, just the very name of it, white paper, tells you how old school this is. It's out of date already, and that thing took years for them to put together. We just don't have the sort of nimble, small system, smart thinking people set up to deal with this, and I'd be very surprised if that's different in the US or indeed in many of the other big power centres.
Well, they clearly don't understand it, Professor Marcus. Do they call you in to try and get you to explain it to them?
I was talking to people in the US and Canadian government yesterday. I've been called a lot lately. I think there is an awareness that people don't quite know what to do, and they are increasingly turning to me, and also turning to all of my academic colleagues and so forth. I think that there's at least a recognition that people know what they don't know. I do think that the UK white paper saying that you won't have a central office of AI is silly for all the reasons that were kind of implicitly just said, which is the government is going to be ill-equipped to deal with the speed of this. And if you just leave it to 20 different regulatory agencies, each of which don't have expertise, you're asking for trouble. You're asking for a lack of coordination. And it's just not realistic that all of those agencies are going to be up on things. So there needs to be, I think, at least some central oversight. I think the United States should consider a cabinet-level AI officer, and you should consider something comparable. We need some people.
So maybe like a G7, we have a G7 meeting of foreign ministers, we need a G7 meeting of AI ministers. Is that effectively what you're saying?
Well, I mean, I'm calling for something similar, which is a global organization, kind of like IMF or the International Atomic Energy Agency, where you have a lot of experts, you have a lot of people in government, you have a lot of people in the companies, and yeah, you have regular meetings. You're like, well, this week the new thing is this thing called, this is a real example, called AutoGPT, where you have AIs training other AIs. What do we do about that? How big a threat is it? Is it a small threat? Big threat? Like, if you have a research arm, you can say, let's do some experiments here and try to figure out what the limits are. Right now, instead, you have like 193 countries. Maybe some of them have read the news about this major news discovery. Some of them aren't even aware of it, and there's like no coordination here. That just can't be the right way.
You're nodding at them because this is the key issue. As Miles discussed, it's not human competitive intelligence. It's what happens after AI gets smarter than human intelligence. Right?
I can't go to a conference. I actually live in Washington D.C. most of the time. I can't go to a dinner or a conference, a meeting without the word AI being discussed. And they're all talking about ChatGPT, and Gary's right. It's not even AutoGPT. There was an experiment run last week called Chaos GPT, where they took a neutered version of AutoGPT and told it to go out and figure out the most efficient way to destroy humanity. It was sort of a test, and it's set to work doing it. There's a lot of this stuff is moving incredibly fast, and figuring out how you can educate policymakers about how to mitigate, regulate, bring transparency to some of those threats, while not preventing what can be breathtaking advances in how we live our lives in much more fulfilling and purposeful ways in society. I think that's a lot of the trick here. To echo Jack's point, though, about white papers and the way government moves, I tend to agree. And Miles may be more optimistic than I, but I tend to agree. I think a lot of the big changes that are going to need to happen probably won't happen until there's some sort of provoking event, some sort of crisis. I don't think that, though, prevents us from starting to have the conversations, at least the way Washington tends to work. At least you want to have the policy container, the framework, the ideas ready, some sort of consensus being built, so that when the opportunity presents itself, kind of like a VC who sees a great startup, right? When the opportunity presents itself, you're ready to jump on it, you're ready to move forward. And I think that has to be happening right now.
Go ahead.
The opportunity that I see right now is to build some global governance. I think you have the governments are afraid of the technology companies. The technology companies are afraid that governments are going to shut them down as they did in Italy. And this means everybody has some incentive to go to the table. That's rare. And I think we should be seizing that opportunity right now to try to do something coherent that is dynamic enough to cope with the speed of the change, to take advantage of the good things and to avoid the bad things. But we need that coordination now. We can't just leave this to the usual mechanisms. It's just too slow.
Miles, one of the more worrying things that you said was that Speaker McCarthy was looking at an AI for Republicans. And one of the experiences we have of recent years is that the Russians were able to interfere in a democracy, and who knows, arguably. It's been debated whether they were able to change some of the results through what they were putting onto the internet. I mean, we're into a whole new ballgame for democracy if AI can put out misinformation and propaganda.
It's not if, it's how much and when. It's going to happen probably in the 2024 election.
Well, yeah, there's no question. I mean, this coming election cycle in the United States, it's a big concern for election security authorities. It should be. But I got to go back to what the other panelists said. In order to respond to it effectively, we've got to start with education. And right now, I mean, I've tried to brief policymakers on this. It's like explaining particle physics to a chocolate chip cookie. I mean, there's just not recognition about what's happening. If I was President Joe Biden right now, I would put the entire cabinet on Air Force One. I would fly them to Silicon Valley, and we would spend the week educating them about what's happening, because there aren't just these security implications for the elections. As Evan notes, there's also really positive implications. I mean, there's the ability to address major health problems, hunger, homelessness, and to do it in real time. And we are missing some opportunities by policymakers not being educated on the subject. But of course, security has to come first. And in order to protect elections or anything else, it's got to start with policymakers becoming technologists and being educated.
Fascinating conversation. We're going to have to leave it there. Evan Burfield, Gary Marcus, thank you very much indeed for joining us.
There's a drone which hit a chemical tanker in the Indian Ocean last night was launched from Iran. Iran has been accused of backing Houthi rebels in Yemen who've been blocking shipping in the Red Sea in recent weeks. The US says it's also shot down 4 drones in the waters. The possibility of hostilities spreading further across the region will concern many international leaders, as Rob Watson reports.
The drone strike on this tanker being escorted to a port in India signal a dangerous new threat to shipping in the region and an escalation of Iran's involvement. Just a few days ago, a senior Iranian commander threatened to close the Mediterranean and Straits of Gibraltar, so the prospect has to be taken seriously. But its foreign minister claims escalation is not in Iran's interest.
For us, regional security is very important. We are not seeking to expand the scope of war. The solution to the problem is not to establish a so-called coalition in the Red Sea, but to stop the bloodshed of women, children and civilians in the Gaza Strip and the West Bank.
There have already been over 100 attacks on shipping in the Red Sea by the Iranian-backed Houthis based in Yemen. The US accuses Tehran of supporting and funding such attacks and is establishing a coalition to patrol the Red Sea to protect what it calls a threat to global trade, not just Israel's.
The Houthis aren't attacking just one country. They're really attacking the international community. They are attacking the economic well-being and prosperity of nations around the world.
The sophistication of Houthi attacks against shipping, including this extraordinary airborne assault on a vessel in the Red Sea, filmed by the attackers themselves, is already having an impact. Hundreds of ships have been diverted from the area at extra cost to owners and customers alike. But despite such attacks and rising tensions, both the US and Iran do seem anxious to avoid a wider war. The shipping companies and their customers will be watching nervously. Rob Watson, BBC News.
So Manchester United has confirmed one of Britain's richest men, Sir Jim Ratcliffe, is to buy a 20% football club. The 71-year-old Ineos Group is expected to pay in the region of £1.25 billion or $1.6 billion for the minority stake. Well, for more on this breaking news, we can go live now to Old Trafford and join our sports correspondent, Nestor McGregor. So, Nestor, we've been waiting for this for a long time, haven't we? How much of a surprise is this?
Yeah, good afternoon, Regini. I think that this is a Christmas present that lots of Manchester United fans would have wanted. You posed the question, how big of a surprise? Well, this deal has been potentially, let's call it 13 months in the making, and there are times where we've been told it's imminent, there are times that we've been told it will happen a week from now, 2 weeks from now, and it hasn't done so. So perhaps a surprise, but not a surprise at the same time. To go to the details of the deal, some of what we just mentioned. Sir Jim Ratcliffe, one of the richest men in Britain, a boyhood Manchester United fan, has acquired a 25% minority share in the club, just north of £1 billion. And I think the important part of the statement is that Ineos Group will be in charge of footballing operations, and that will be key for lots of Manchester United fans watching this. The Glazers have been in charge of the club since 2005. 13 months ago, they said they were looking at potential investment, and there were two serious bids from a Qatar businessman and from Sir Jim Ratcliffe. Both wanted to take total control of the club, but the Glazers decided against that earlier this year. Sir Jim Ratcliffe then put in a bid to own a portion of the club, and that's this deal that's been taken so long to come to the forefront. Today, though, it was announced, as we said again, 25%, just over £1 billion footballing operations of the men's, women's, and the academy team. And that would be key for a lot of people. Manchester United, one of the biggest clubs in the world, maybe in a bit of turmoil on the pitch at the moment, struggling in the Premier League, already out of Europe. It was seen that maybe the Glazers weren't doing the job of business on the pitch. And Sir Jim Ratcliffe, who already owns a French club in League One and a successful racing team as well, does have some sporting pedigree. So yeah, certainly Manchester United fans may be very, very happy at the news, but we talk about him being a minority shareholder. The Glazers are still in place. Sir Jim Ratcliffe does own a part of the club, but what does that mean when it comes to footballing operations? Will he be able to hire and fire managers? Will he be able to buy players that he wants to buy if the Glazers and him have some disputes? So all very interesting, Regina. This is just a breaking news at the moment, so we're still finding out some details and we'll be waiting for some more as well.
Now, 4 months ago, the Christian community in the Pakistani city of Jaramala saw nearly 24 of their churches and tens of homes ransacked by hunter protesters. In the aftermath, the government promised aid to rebuild, but as they prepare for Christmas, many are still living with the damage and shock of those attacks. But our Pakistan correspondent, Caroline Davis, reports now from the city.
Joy and Christmas hats. Familiar celebrations mask painful memories. Jaramala's Christians have much this year. Simon lives in the only room left of her family home. Rebuilding is slow. Life in this charred space is exhausting. We are tired now. In this one room, there is no facility. There is no light, no water. Everything is finished. We don't have anything. She and her family received 2 million rupees. That's not enough. It takes a whole lifetime to build a house. Our parents saved each and every penny for the house, and now it's all burned. Whatever we had, you can look at the house. It's all burned. For 2 million rupees, you can't rebuild this whole house. Jaranwala's authorities told us that the amount given to families was based on an assessment of the loss of each house. This is what caused that loss. Hundreds gathered in Jaranwala after 2 Christians were alleged to have desecrated the Quran, allegations of blasphemy. It turned violent. Churches, homes, burnt and ransacked. 4 months on, the authorities say all the churches have been rebuilt. This was the church. Now this looks completely different from the last time we were here, when the walls were completely blackened, and instead, of course, it's been completely redone. More than 350 were arrested, but none have yet stood trial. Do you think the police should have moved faster?
There's a process flaw. The biggest stakeholder may be public, but there's one hidden bigger stakeholder, which is
which has much more stakes than the people, and you know that is the police department, that is the government itself, because we want to show people that such like acts will not be tolerated in future. If we don't ensure justice in these cases, such like incidents will keep happening.
Prayers, thoughts on a better year. Buildings are repaired, but trust, they tell us, will take far longer. Caroline Davis, BBC News, Darren Waller.
アインシュタイン、世界一の天才と称された男が皇居を守ったわけ。
Now, the US Department of Defense has accused Iran of launching the drone that damaged an oil tanker off the coast of India. The attack happened 320 kilometers southwest of Iran and caused a fire on board, which was extinguished. Let's speak live now to our correspondent, Amrazan Ethrajan, who's in Delhi for us. And Amrazan, the Iranians say they had nothing to do with this. Tell me the latest that you are hearing.
Now, what's happening in the Red Sea in the past 48 hours has really shaken the commercial shipping operations. Now, the U.S. Central Command has issued the latest update listing out a number of attempts made on tankers and other commercial ships passing through the Red Sea. They say 2 anti-ship ballistic missiles were fired by the Houthi rebels from Yemen, and they are regarded as the proxies of Iran. And none of the ships were damaged. And again, 4 drones were shot down by the U.S. warship, and 2 other ships were hit. One had a narrow miss, a Norwegian ship. Another Indian tanker was hit by a drone, but not much damage or casualties. Now, we are talking about the attack on Friday when India-bound ship, which one of the British maritime agencies said Israeli-affiliated tanker carrying oil from Saudi Arabia to India came under attack about 200 nautical miles off the coast of Gujarat state in India. That has also shaken the confidence of the industry. Now, the US blames Iran, saying for the first time that they're directly involved in an attack, but the Iranian authorities, they deny. So it is still a mystery who carried out. No one has admitted responsibility. But what it shows is that how one of the busiest routes now has come under attack by these rebel groups or some others that is threatening the industry.
Yes, that's the wider concern, isn't it? In terms of what the authorities are saying, what are the Indian authorities saying about this?
The Indian Coast Guard has given an update on what happened to MV Ken Pluto. That was the tanker that was attacked off the coast of India on Friday. Now, this ship was damaged. It caught fire, but it was extinguished. It also took in some water. Now, a Coast Guard ship is accompanying this tanker. So it is likely to reach the port at Mumbai tomorrow to assess damage and to carry out any repair work. And then they will decide the future course of action. And in fact, the Indian Coast Guard also deployed a Dornier surveillance aircraft to make sure that the ship doesn't have any other threat in that particular area. So it is a concern for India, which heavily relies on oil and other supplies from the Middle East. So it's not only in the Red Sea now, it's spreading to other areas. But people might question, how come a drone far away from any other country, nearly 2,000 or 1,000 kilometers away, can hit a target, whether it was launched from another boat or a ship? So that is a question for defense experts to answer.
And Rosanna Ethrajan there in Delhi. Thanks very much, then. Thank you.
and strong. Wow. Turn around and stick it up. Wow. Wow. Fine specimen. Wow. Drop it down, I'll pick it up. Wow. 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 Drop it down, I'll pick it up. Wow. Wow. Wow.
Spotify をお聴きの皆さん、このです。今年もあと1週間です。私は今年、アーリーノイズアーティストに選出していただき、アルバム To Moon をリリースして全国ツアーを行ったりと、充実した1年でした。皆さんはどんな1年でしたか？ RF でほっと一息ついてください。今年も1年、お疲れ様です。良いお年を。朝日生ビール、通称マル F、日本の皆さん、お疲れ様です。
Spotify をお聞きの皆さん、ビアリストックスです。今年も残すところあと1週間です。僕たちは全国ツアーやフェスを回ったり、ドラマのエンディングテーマ、幸せの回り道をリリースしたりと、充実した1年でした。皆さんはどんな1年でしたでしょうか。マルエフでほっと一息ついてください。今年も1年、お疲れ様です。良いお年を。朝日生ビール、通称マルエフ。日本の皆さん、お疲れ様です。
Spotify をお聞きの皆さん、ともです。今年もあと1週間です。私は今年アーリーノイズアーティストに選出していただき、アルバムトゥームーンをリリースして全国ツアーを行ったりと充実した1年でした。皆さんはどんな1年でしたか？ RF でほっと一息ついてください。今年も1年お疲れ様です。良いお年を。朝日生ビール通称マル F、 日本の皆さんお疲れ様です。
キファイをお聞きの皆さん、マルシーです。今年も残すところあと1週間です。僕たちはフェスに出たり、バストラッカーに選ばれたり、アルバムキャンドルをリリースしたりと充実した1年でした。皆さんはどんな1年でしたか？マル F でほっと一息ついてください。今年も1年お疲れ様です。良いお年を。朝日生ビール、通称マル F、日本の皆さん、お疲れ様です。
Greeting cards have all been sent. The Christmas rush is through. But I still have one wish to make. A special one for you.